Welcome back to Bloomberg Surveillance. A quick check on the markets. Trading is thin around the world. A lot of markets in Asia, including South Korea and Japan, are closed, as are several markets in Europe, including over there in London. In Paris and Germany. We talk about here in the U.S. and a slight bid that we're seeing into U.S. futures. The S&P futures up about 0.3%, a potential punctuation mark on a 20+% rally on a year-to-date basis. Euro-dollar relatively unchanged, belying the strength that we saw on the dollar this year, a 7% rally versus its main basket of peers. A 10-year yield camped out around 4.5%. Brent crude prices up about 7%, 0.7% on the day to 71.51. And we should point out that big rally we saw in natural gas futures yesterday, about a 13 to 14% rally, pulling back just a little bit today, down about 4%. And that is where we start right now at this hour. A closer look at commodities under surveillance this morning and the outlook in 2025. We talked about gold a little bit earlier. But how about cocoa futures? Up more than 170% on a year-to-date basis. Best performance going back to 1960. Record high here, surging on renewed supply fears, and that's driving the most active cocoa contract in New York to make its biggest intraday jump going back to May. We should point out coffee futures also higher as well here, heading for what is going to be yet another record high for those commodities. Kona Hack joining us right now, EDNF man, looking ahead, writing that the outlook for commodities is going to remain, well, sluggish next year due to potentially strong U.S. dollar, unless China stimulus changes that demand. I'm pleased to say that Kona joins us right now to talk a little bit more about that outlook. And I think we have to kind of start, Kona, with actually what drove these phenomenal gains in prices this year. Was that just about the supply-demand dynamics? Was it about geopolitics? Was it about weather? What?
So for the two top performing commodities, coffee and cocoa, yes, it was definitely supply-demand dynamics, and which in turn is all about the weather. So with coffee, we had extreme drought, extreme dry conditions in the two major producing countries, which is Brazil and Vietnam. And in cocoa, we had not necessarily directly weather-related issues, but certainly the supply side where we had, poor yields in Ivory Coast and in Ghana related to disease on, old trees. And yes, a little bit of dry weather. Recently, the Harmattan winds in the West African region have come a bit early. So that's also causing problems to the crops. I think a combination of massive supply problems have definitely hit both cocoa and coffee, which means we've got really tight deficits for numerous seasons in a row now.
And so, Kona, I am curious about this idea of how the market adjusts to this, because you look at the trajectory of prices, how fast they went up here, and we know all the collateral requirements and other things like that. It's caused a lot of disconcert, a lot of issues for a lot of the brokers and the dealers out there. Is that volatility, I mean, irrespective of where prices go, is that volatility that we saw this year going to be repeated in 2025?
Yes, the short answer is yes. And the reason for that is because stocks are very, very tight, whether it's exchange inventories or actual physical stocks, both at origin and also at the destination, the importing countries where most of the consumption is happening. Stocks are ridiculously low on a historical level. So when you don't have that buffer, ultimately what happens is price has to give. So you get extreme volatility because you haven't got that necessary cushion that you need. And what's worse is that these trees of both cocoa and coffee, they're not annual crops like soybeans or wheat, where when you have a good price, the farmers will respond, they'll plant more the next year, and you get a good immediate supply response. Unfortunately, with cocoa and coffee, the supply response is very lagged. So you're going to see, in response to the current high prices, you're going to see a lagged impact, maybe in a couple of years' time, or late, earliest a year to 18 months. So you're not going to get that supply comfort coming earlier. And that's on the supply side. On the demand side, you're also not going to see an immediate contraction in demand to address that supply-demand imbalance. And that's because, again, there's very inelastic demand for both coffee and cocoa. People are not ready to give up their cup of coffee. People are not ready to give up their chocolate. It's a small luxury that they're willing to pay. And so that inelastic demand means, again, you have no movement on the supply demand in a hurry, which then leads to volatility, as you were mentioning.
I can certainly relate to not giving up on the cocoa and the coffee. But Kona, talk to us a little bit about it from a trading perspective here. I mean, the last time we saw these moves in various agricultural products, it was almost from a lot of macro tourists, a little bit of a hedge against inflation. Could that, if we do see an uptick next year, still play that role?
Yeah, so I think that's something that seemed to be growing, from a very small from a small point of view. I think what we can begin to see is the hint of inflation being very sticky and not having disappeared, and if anything, resurging. Now, if that starts to take off in a bigger way, then you could start seeing the world, and particularly the traders, becoming more aware. Okay, so if we have inflation again, what do we do? In that context, commodities could suddenly become an interesting asset class again, because as you know, commodities are a very good asset class as a hedge against inflation. Certainly, we saw that in 2022, just after the Ukraine war, when everything went up, whether it was energy or food, you saw commodities as a complex pickup. Now, could we see a repeat of that? Potentially, but nowhere nearly as extreme, because obviously we're not seeing double-digit inflation. We're going to see more of a sticky inflation, which is definitely lower than 2 years ago, but higher than what the central banks would like. So if that's the case, do you want to put money into commodities? I think people will pick and choose. I think things like gold might be a good option, because that's attracting safe haven demand, and there'll be no shortage of uncertainty in the macro environment in 2025. Others will be pick and choose based on their supply demand balances. So I think, again, some of the soft commodities will do well because of the weather issue. You could start seeing, certainly if China's stimulus starts to pick up, I think certainly some of the metals could do well. Arguably in 2024, some of the metals overran their fundamentals. I think copper rallied more than they needed to, and then it took a hit when they realized that China's economy is not as strong. But if the stimulus starts to become better than expected and longer lasting, then maybe the metals could do better. I'm a little bit concerned about grains. I think grains look very well supplied, and I think in the environment of tariffs and trade wars with China in particular, you could see the CBOT futures for grains and soybeans remain pretty under pressure.
So Kona, when we talk about this, I mean, I follow your fundamental narratives on if there is an inflation uptick, these are some of the assets that could benefit. Is there a risk, though, of folks that aren't maybe used to this kind of commodity trading or the volatility you mentioned to Romain as well, almost hurting the way some of these prices work and are traded? And I have specifically referenced some of the moves that we saw in 2021 and 2022, because so many people who don't traditionally trade commodities ran to the asset as that hedge. Do you see a risk of that happening in 2025?
I think we will not see a rush to commodities like you saw in 2021. And I think big reason for that is because the dollar is very strong. Commodities and the US dollar have a natural inverse correlation. So the fact that we're going to 2025 with a very strong 2-year high in the US dollar index, and my opinion is that the dollar will remain strong in 2025 because of Donald Trump, president-elect's policies, which are all pretty inflationary, which in turn would be supportive of stronger dollar. If we do have that environment, then I think it's going to be difficult for commodities to outperform. So I think that will be the biggest headwind for commodities, generally speaking. And so therefore, you will not see a broad-based increase in the commodities asset class as a whole. But as I mentioned before, I think people will selectively choose which markets to go into. Even oil today, it's been pretty stable for 2024 as a whole. Yeah. But if Iran were to see increased sanctions, Russia too, then suddenly oil could be an interesting one due to geopolitics. Yeah. This year it weathered it really well despite numerous tensions around the world, in the Middle East in particular. Oil took it all in its stride, but Iran could be another issue if supply were to be impacted there.
All right, going to have to leave it there. Wonderful stuff. Going to hack over at EDNF. And man, a closer look here at the commodities space, sitting on losses in the energy space, but some of the metals, particularly in the precious metal space and in some of the soft commodities with regards to cocoa and coffee, having phenomenal years. A lot more coming up here on Bloomberg Surveillance. A conversation up ahead about valuations with Brooke May. of Evans made wealth. And we're going to talk to Jason Baumgarten. I don't know if you've been taking a look at all the CEO departures that we've seen this year, but Jason's going to have some perspective here on whether we see a repeat of that in 2025. Pavel Molchanov having a conversation up ahead on renewable energies. And if you bought luxury real estate in Florida, you probably bought it from one of our next guests. All that and more coming up next, right here on Bloomberg Surveillance.
In case you missed it, on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
To succeed in Wall Street, what skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out. Which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency. The other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy. If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Is seeing that the economy is not weak.
We're getting to a point where equity risk premiums are incredibly narrow.
I don't know what to expect, but I'm not really sure if markets really know what to expect. I think that creates some volatility.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
7 a.m. in New York, 1 p.m. in Paris, midnight in the Fiji Islands. Happy New Year to our audiences worldwide. This is Bloomberg Surveillance. Romain Bostic in our world headquarters in New York. Kriti Gupta over in London. Kriti, as we take a look here at financial markets, closing out what has been a phenomenal year. The S&P headed for its 5th straight quarterly gain, and that's going to cap a 24% rally on the year. You put that together with the rally we had last year, Kriti. The best back-to-back years right now, at least for U.S. markets, going back to 97, 98.
Well,
That's a pretty decent stat. I think what's fascinating is in just the last couple of hours, it feels like the sentiment around the markets have completely changed. Romaine, when I came in for our morning shows here in London, the markets were down, and they were down hard. You've seen the sentiment just completely evolve in the future story now, deep in the red, now certainly into the green.
And it's kind of interesting, too. We talk about kind of what sort of led this rally. We talk about the start of the year, certainly here in the U.S. It was all about those big tech companies. Some of that was a play on technology, but a lot of it, as you know, Critty, was a play really on fundamentals, on cash, on profitability. But then we saw that rally broaden out here in the U.S., and then now it's kind of narrowing once again here, Critty, towards the end of the year.
I think what was so surprising of this year is that even though I think we were expecting so much of that concentration risk that you mentioned, that the real shock to me was how the market sold off around the Fed story. The fact that so many Fed cuts were actually priced in when I, like you, attributed it to, say, the Trump trade or the broadening or even the economic resilience you saw in the data. But there were still so much of that monetary policy baked into a market that maybe didn't need it.
And monetary policy was a big part of the story this year. Could potentially be next year. Even if the Fed doesn't do anything, that in and of itself could be a big story, too. A lot coming up this hour. A conversation up ahead in just a second with Brooke May over at Evans May Wealth on why she says the market might actually be overdue for a correction. And we're going to talk with Jason Baumgarten over at Spencer Stewart on the record number of U.S. chief executives who left the corner office this year. Pavel Molchanov over at Raymond James going to be joining us to talk about his outlook for oil and renewable energy as well. But let's begin this hour with a closer look at stocks which are on track for their second straight year of 20% plus gains. However, 10 stocks, just 10 stocks accounting for more than 59% of that advance, going back to the S&P bottom back on October of 2022. New York University finance professor Aswath Damodaran spoke to Bloomberg a little bit earlier here about the narrow breadth that we've seen in this market.
I've never seen a group of companies carry a market for as long a period as the Mag 7. The Mag 7 companies alone, if they were a market, would be the second largest equity market in the world after the U.S. equity market. These companies, at least most of them, are cash machines. I've never seen cash machines as lucrative as these companies are. And I don't see the cash machines slowing down.
And we go from one of the brightest minds in finance to one of the other bright minds in finance, and that is Brooke May over at Evans May Wealth. And Brooke, I do want to start off with what Professor Damodaran was talking about. Kind of two sides of the coin here. On one hand, you don't want to see this tight concentration in the market. On the other hand, we're talking about a tight concentration of companies that are just kind of just pumping out cash at levels that we've never really seen. I can't really think of any real parallel other than going back to the robber baron era at the turn of the last century.
Absolutely. When you look though at stretched valuations, which there's been a lot of criticism of in the S&P 500, a lot of those higher PEs are attributed to those top 10 stocks. And when we look at their earnings growth rates, they're strong. So that's what you want. You want companies that are growing their earnings that can justify those higher PE ratios. When we looked at the big tech going into 2024, earnings were expected to be up 28%. Whereas the other 493 names were only expected to have earnings growth around 7%. Going into 2025, the narrative has changed. Big tech earnings are expected to be up about 21%, but the other 493 names, earnings are expected to be up 13%. So we are seeing a broadening in participation, and we think that if you peel out those top 10 names, the PE ratio that you have on the market is much more reasonable and in line with the 5- and 10-year averages.
Well, that seems to suggest that we could see a meaningful extension of this rally, and that doesn't necessarily mean we won't see pullbacks or even a correction in between. I am curious as to what you think the biggest risk for this market will be next year.
Environment that's good to be an investor. We've got low unemployment, we've got deregulation on the horizon, we've got an economy that's growing, and so our base case is that the market will do well based on the broad economy. However, there are quite a few factors that we're looking at. Some of them are policy related, and I think that that's another reason why the Fed's going to be cautious. We want to wait and see. President Trump has been very vocal about what policy initiatives he wants to take. And there's some concerns around what tariffs might mean for the economy or what deportations could mean for the economy. So we're ready to pivot if it looks like there are factors at play that might be somewhat of a speed bump for the market.
Brooke, if I can ask you a more sector-specific question, especially around the policy story. I mean, I feel like a key part of the Biden administration, or the Biden trade, if you will, was the CHIPS Act and this massive move you saw in the chip sector. Not that just wasn't just driven by the AI story or the tech story, for example, but actively was because the federal government was granting funding to so many of these companies, Intel, Micron, et cetera. You saw that in the Trump trade as well, almost Biden unwind from that sector. Is that the right approach when it comes to how you stock pick here, what sectors the federal government funds at the end of the day?
Not necessarily, because that can change. And, we're looking for companies that have long-term sustainable earnings growth. The ones that we like right now, NVIDIA, Broadcom, Taiwan Semiconductor, and the hardware space, we think can continue to do well regardless of subsidies. That said, we are shifting this year our focus more towards companies who've also embraced AI, but are doing it from a software standpoint. And they've been able to show their customers and their clients that they can be accretive to their earnings and help grow their business with additional services and products. So we're looking at companies also like ServiceNow and Salesforce that are using more of the software side in addition to the hardware.
So, Brooke, some of the companies that you just named, they have one other thing in common, is that they're all sitting on a lot of cash on their balance sheet. A lot of the tech companies are as well. As a more long-term investor, how are you thinking about cash on balance sheets? Is that something to be deployed, or is that something to use as a cushion for policy uncertainty?
When we look right now at CEOs and what they're telling us, the sentiment is okay. It's not overly optimistic, but it's okay. And when they tell us where they're going to spend, it's in CapEx, R&D. We expect CapEx and R&D spending to be up about 8 to 9% over the next year. But we also see M&A activity and share buybacks and increases in dividends to be really even more of a commitment when it comes to their spending. We think M&A spending could be up 20%. Dividend increases could be up 7%. So there's a lot that they can do with that cash that we think will be beneficial to investors, and they're planning on deploying it.
And just to kind of wrap this up, Brooke, I am curious too, because we talk about the challenges for 2025, and it obviously goes beyond fundamentals. You mentioned the policy issues here in the U.S. and obviously geopolitical issues that frankly still have not been resolved. Do you think there's enough hedging in the market right now? This has been a big topic, not just amongst traders themselves, but even amongst long-term investors. Are people protecting their portfolios against those potential exogenous shocks?
I don't think they are. I've been in the market for 25 years, and I've seen the tech bubble burst. I've seen the Great Recession, and this is an environment where investors have made money for several years, and you let your guard down. We don't see though right now an overextension of margin and leverage, which typically to see a bubble burst or a big correction, you're in an environment where you don't have cash and you've got a lot of margin. So we're not necessarily overextended, but I don't know that investors are necessarily taking a cautious approach right now.
All right, Brooke, going to leave it there. Brooke May over at Evans May Wealth. We thank her for her time and Critty. It was kind of interesting. We talk about this 24% rally in the S&P 500 this year. $1.5 trillion in market value added to the S&P 500. Yet there were just about 8 people who accounted for 43% of that, and you can guess who they are. It's the Elon Musk and Mark Zuckerberg and Jensen Huangs of the world. Their wealth, collectively, those 8 folks, going up by $600 billion this year alone.
You know what's surprising me, Romaine, is that their wealth affects everyone's wealth via the stock market, right? If you're talking about this bromance between Elon Musk and Donald Trump, this brings me to back when Elon Musk bought Twitter, and it actively affected Tesla shares. It actively affected the S&P 500. If that bromance dissipates, does the stock market drop too?
Yeah, I mean, that's a big part of the question here. And of course, we talk about these sort of singular individuals and how so much of their fortunes, at least going forward in 2025, are going to be tied, certainly, to some of those policies coming out of the White House and favoritism, if you will. All right, let's get you an update on some of the other stories going on out there this morning. Yahaira Jacques is standing by right now with our Bloomberg Brief.
Hi, Hi, Romaine. Cities around the world are preparing to ring in the new year with celebrations highlighting local cultures and traditions. In Auckland, New Zealand, they've already welcomed 2025 with a light display recognizing the city's indigenous tribes. At 8 a.m. Eastern, Sydney, Australia will ring in the new year. Meanwhile, South Korean authorities are investigating airport infrastructure at the site of the Jeju airplane crash. This as questions grow over how a concrete wall at the end of the runway may have contributed to the disaster. International safety experts questioned if the crash was made worse due to the position of the structure and being made partly of concrete. And online ticketing platform Vivid Seats might be exploring a sale after receiving takeover interest from private equity firms. That's according to sources. Vivid Seats shares jumped yesterday on the news, but are still down more than 26% this year, as you can see. Sources say the company's deliberations are ongoing and there's no certainty it will lead to a transaction. Vivid Seats said it, quote, doesn't comment on rumors or speculation. That's your Bloomberg Brief. Romaine?
All right, our thanks there to Yahaira Jaquez there for that Bloomberg Brief. And Creedy, I'm not sure if you actually plan to go out on this New Year's Eve over there in London, but there was an interesting poll here in the U.S. showing that the majority of people, they just stay home.
I mean, I think that's what I'm going to do. Me, my dog, watching the fireworks on TV. That sounds like a dream, Romaine.
Yeah, I mean, I guess I'm one of those people, too. I mean, we are going out, but I should point out we're not going out tonight. We're actually going out in the afternoon, and we'll be home well before the fireworks and all of the festivities start. But it gets to this idea here of just how much of this holiday, if you will, is actually a revenue generator. I know there are a lot of folks, certainly in New York, who want to go out and brave, the elements to see the ball drop or go out to a nightclub or restaurant, if you will, here. But there's so many people that just decide, you know what, it's just not worth it.
Yeah, absolutely. I don't know about you, but here I'm learning a lot about some weird kind of traditions that Europe has. I learned today, for example, that in Germany, they take little lead or wax figures, for example, throw them in water, see what form they make, and that's a fortune teller of what their new year is going to be like. And I've got about 20 more of similar examples.
Oh, yeah, there's a lot over there. And, of course, back here in the U.S., we have our own traditions as well. And, of course, as we bring in the new year around the globe, actually closing in just a little bit's time here, we're going to start to see Russia actually move on to the midnight hour here. Vladimir Putin already out with the statement in his New Year's address, marking his 25 years in power and what he is calling his, quote, proud achievements. Of course, Vladimir Putin going to be a key figure in the news heading into 2025, given the war in Ukraine and his relationship with the incoming president of the United States of America, Donald Trump. When we come back here on Bloomberg Surveillance, we're going to take a closer look at what's going on in the C-suite. We're going to dive into the reported uptick in CEO departures, record levels this year. Jason Baumgarten of the leadership advisory firm Spencer Stewart is going to be joining us to talk about what's behind the trend, and more importantly, whether it continues. You're watching Bloomberg Surveillance.
To keep reading World Cup. This is a three as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
U.S. futures pointing to a slightly higher open. The S&P 500 futures right now up about 0.4%, a punctuation mark on what has been a 20% plus rally on a year-to-date basis. Similar percentage gains for the NASDAQ on a year-to-date basis for the Dow and the Russell. You're sitting on gains on a year of roughly around 10% or so. Most markets now have started to shut down. Quite a few in Asia are already closed for the New Year's Eve holiday, some in Europe as well as we approach the midnight hours across the world. Euro dollar unchanged on the day. Your 10-year yield here in the U.S. camped out right around 5.5%, unchanged on the day as well. And an uptick here fractionally for WTI crude in New York, 0.9% to 71.60 a barrel, despite the fact that on a year-to-date basis is going to end the year, it appears, roughly unchanged. Of course, oil, energy, and commodities, those were some of the big stories of the year, but another big story this year, and it is under surveillance, and that is the number of CEO departures. Here's the latest on that. Record numbers of chief executives at public U.S. companies are reportedly leaving their posts amid increasing scrutiny. Jason Baumgarten of leadership advisory firm Spencer Stuart saying it's hard to draw meaningful conclusions about why these CEOs are leaving their jobs from broad statistics alone. But at Spencer Stuart, they believe you need to understand the 3 C's: the CEO themselves, the company they were leading, and the context in which they were operating. Pleased to say Jason Baumgarten joins us right now, and I want to start with that 3rd C, and that is the context. Has the job just gotten too hard?
Well, as you know, there's a lot that can be going on in a company and with a CEO's tenure. You can be facing enormous uncertainty from global tariffs, a huge boom from AI. And so depending on what situation a company finds itself in, what is going on in the industry, and then how is the company responding, it's certainly something that matters. And context is both about the industry, but it's also about how that company has historically responded. Does the CEO have a plan, and how's that plan actually seeing the results that they and the board of directors and ultimately the shareholders want to see?
I am curious about these statistics. I don't think we have a breakdown exactly of how many of these departures were willful and how many of these were folks forced out. But when you look at the trends yourselves, I mean, what do you get a sense of? Is this basically the board saying, okay, we need a leadership change, or is this the individual CEO basically just saying, you know, I'd rather do something else with my time and my life?
It's a great question. And the reality is it's all of those things and more. In some cases, CEOs are just saying, hey, this is a tough job. There's a lot more media scrutiny. There's a lot more always on attention. There's a lot more stakeholders to make happy. And it's harder and harder to eke out performance. As your segment before showed, so much of the performance is driven by so few companies. And so it's harder and harder for CEOs to see the value creation under all of this and to have an increasing amount of pressure on them as individuals. So some are just saying, hey, I've done well. It's time to let the next person lead. The context is changing. Let's have a changing of the guards. In other cases, the boards are sitting there saying, we want a different rate of performance, or we want a different change in direction, whether they're doing that or they're doing that under the scrutiny of other stakeholders. We do see boards taking action faster. Our own studies and research on the topic, the faster boards take action, the more likely the company is to perform well after a decrease in performance. So it's sensible for a board to take action. On the other side, some CEOs are just saying, hey, it's time. I had a good run. I delivered a lot of value, and time for the next generation. I had a CEO recently tell me they retired at 60 They were thrilled. They were taking their first real vacation, as they put it, in 45 years. And they said they were getting their knee replaced, going for a hike, and hanging out with the family for the first time really in their professional career, because they had just been fully on 24/7 for 40 plus years.
Wow, that is quite the run for that person. Jason, I'm curious about the approach CEOs use here. I'm curious about if the limelight is something that helps or hurts their case. I mean, I'm thinking of, say, Jamie Dimon, a Tim Cook, or a Mark Zuckerberg, who maybe could benefit from the spotlight, but then maybe bring about more scrutiny as well. How do you think about that?
Well, we often focus on a few individuals, and the reality is there's 1,500 CEOs in S&P 1,500, and there's 500 in the S&P 500. So a lot of executives, a lot of leaders who are trying to do this in their own companies to drive value, to drive employee satisfaction, to drive satisfaction in their communities. All of those CEOs are under scrutiny in their own ways and shapes. So they all have to think about how to yield that public persona carefully, and to really make as many people happy while still delivering on the fundamental values that they're trying to deliver on for stakeholders and for shareholders.
Well, Jason, we're on a financial network at the end of the day, so I've got to ask you a question about buybacks. I mean, this is something that has been such a point of contention for so many people when it comes to, do CEOs just want to see their stock rise at the end of the day in terms of compensation, or in terms of buybacks, or in terms of shareholders, or whatever? How do you think about that?
I think increasingly boards have to think about, are they seeing the value creation they want from the CEO, and is it following the plan that the CEO put forward and that the management team is executing on? If they're seeing the results, sometimes those are interim steps, interim things, whether it's revenue increase, margin increase. Those then have to translate in the market. But as you know, those don't always translate right away or in obvious ways. So the board has to be that go-between to say that they're seeing the results they need from the CEO and the management team on behalf of shareholders that will ultimately lead to shareholder increases. If part of that plan is to buy back shares, then that's something they're going to evaluate. If they see that as a part of the plan that they're not as happy about, then they're ultimately going to value that as part of the CEO and the management team's evaluation at the end of the year.
Jason, I am curious, though, also. I mean, we talk about some of these CEO departures in the context of those folks who maybe, just like I said, just kind of done with the job. There's kind of the opposite effect, too. You have some transition issues of certain CEOs that, let's just say, are long in the tooth, have been in the job for quite some time. Not to say they're not doing well, but there are a lot of questions as to what's the transition. You know, whether you're talking about a JP Morgan, whether you're talking about a Disney, for example, as well. I am curious as to how proactive these boards are in making sure that for some of their CEOs that have been in place for a long time, that are getting to an age where you have to start thinking about who's going to come in next, how much influence they really have to make sure that there is an orderly and smooth transition.
Well, listen, we do a survey every quarter called the Measure of Leadership. We ask 2,000 CEOs and board members what's going on in their roles and in their companies and in the general context. Two things that stood out to us in this last survey that we did. One, CEOs and boards were unanimous at the amount of uncertainty in the economy. Roughly 80% in both groups said it's more uncertain. The second thing is that in light of that, only about 50% of boards reported that they had robust succession plans in place. And many of them, when pressed on the topic, said that they wouldn't have multiple options, which is what we really look for, is does a board have multiple options? The final thing that we're seeing is a real trend away from it has to be an internal candidate as a badge of success. The reality is boards should look internally and externally at their candidate pools and really make sure they're doing all of that diligence before the time comes. And finally, it takes real work, and it's uncomfortable work for boards to ask these questions of CEOs, many of whom have been in the seat for, the average is 8+ years. Even though that's down a little bit, the reality is if you've been on a board for 8+ years with a CEO, you've got to sometimes say, hey, does the strategy need to change in addition to the CEO as again, that context might change for this CEO that the prior CEO didn't have to wrestle with.
And just real quickly here, are those skills still transferable? I know in the past we used to always talk about this idea that being a CEO was just all about management. If you managed a food company, you could manage an industrial company or a financial company. It was just management. Is that still the case?
I think we are always seeing industry shifts, CEOs coming from one industry going to another one. The reality is that it's a slightly scarier thing for a board to do, but it can work. And CEOs who are great people leaders, who are great at thinking about how to create value, great at asking the right questions, great at recruiting talent, can usually drive value as long as they're willing to put the extra cycles in to learn what they don't know and bring that beginner's mind to learn about the industry if they are shifting industries.
All right, Jason, going to leave it there. Jason Baumgarten over at Spencer & Stewart, the leadership advisory firm. A closer look at the record number of CEO departures that we've seen this year, at least based on the tally that we've seen coming out of Challenger Gray. When we come back, one of the hottest sectors to start the year, that was energy. To end the year, well, it's one of the worst performers. A conversation coming up with Pavel Molchanov over at Raymond James. His outlook for the energy sector, where oil prices are headed, and where is exactly that renewable energy trade. The sun coming up over New York. This is Bloomberg Surveillance.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. We absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
The Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
S&P futures right now pointing to a higher open, looking to snap a 3-day losing streak here on this final trading day of the year. S&P futures higher by roughly about 0.4% here on this day, well off the record high set back on December 6th, but still punctuating a year that is now a gain of roughly about 24%. NASDAQ and Russell futures also moving higher here on this morning. In fact, equity futures across the board are in the green right now. Yields across the board are lower. We should point out the volumes today are light here on this New Year's Eve, but we did find a couple of stocks worth watching here on this day, with just about 2 hours away from the cash open of equities. Let's get to our morning movers right now with Yahira Alquez. Yahira.
Hi, Romaine. We start with Sangamo Therapeutics. Those shares are down more than 50% in the pre-market after Pfizer decided to end its partnership with the company for a treatment meant to treat hemophilia A. Pfizer is saying that there's just not enough interest for another gene therapy option for the disorder. As for why the shares are plummeting, that's because analysts are warning that this could worsen Sangamo's liquidity issues. Next up, we have MicroStrategy. Those shares are rising 4.7% in the pre-market, and that's after the company, which has been stockpiling Bitcoin, said it's buying more, $209 million worth, and that is less than the amount that it bought a week ago. As for why the shares are rising, well, it was part of the tech sell-off yesterday, so it looks to be making up some of that. Also, you are seeing Bitcoin prices rising today, and we know that where Bitcoin goes, MicroStrategy follows. And last up, we have Tesla. Those shares are up some 1%. They also sold off yesterday, but look to be on the mend today, even though we do have a report out that Tesla is recalling more than 77,000 vehicles in China due to software issues and even potentially faulty airbags. But something to watch out for this week is the company is set to report fourth quarter and full year deliveries, and that is set to come on Thursday. Romaine?
Absolutely a phenomenal year, though, for Tesla. 68% gain in that stock on a year-to-date basis, and MicroStrategy, just a phenomenal year, up almost 400%. In fact, one of the best performing stocks among the 1,000 biggest companies out there in the U.S. We do want to turn our attention right now to the commodity space, and specifically energy. Oil markets, well, they're pushing higher here in the last trading session of the year. This after we got a report that factory activity in China did expand for a third straight month. Pavel Molchanov over at Raymond James, he's looking ahead to next year. He says that, well, they're forecasting oil prices to be largely range-bound. However, the main energy story of 2025, which was also the main story of 2024, is set to be electricity rather than oil. Pavel joins us right now to talk a little bit more about that. And Pavel, let's talk about it here. I mean, if you had told me coming into this year that some of the biggest gains in the equity market would be utility and power companies, I would have said you're crazy. But here we are at the end of 2024 talking about utilities and power companies. That continues to be the story next year?
Yeah, and this is the derivative trade on AI. So the euphoria around AI touches what we might call the picks and shovels of the electric power industry. So the utility stocks, the equipment providers, so everything from, gas turbines, wind turbines, solar panels, battery systems, and also the construction companies that are, physically building all of this energy infrastructure to accommodate the boom in electric power consumption.
When we talk about the building of this infrastructure, and you have obviously new infrastructure coming on here in the U.S., you have old infrastructure, old nuclear plants coming back online here. Is there enough out there, I guess, if you will, for these companies to draw on, or are we going to be facing significant shortages in power given some of the demand needs out there that we know of, at least when it comes to computing and AI?
Well, our listeners do not need to worry about, physically running out of electricity, at any point in the foreseeable future. That's not going to happen. What is true is that power prices are already trending up. In fact, they've been up since pre-COVID by about 25%, and we should expect power prices to continue moving higher. In part because of the additional demand from the data center build-out. And look, let's also keep in mind the geographic differences here. The bulk of the data center, or the largest portion of the data center build-out, is happening around Washington, D.C., Northern Virginia, Maryland, a little bit into Ohio, There's not as much happening in the western half of the U.S. There's also, by the way, data center build out AI related in Europe, in parts of China. So this is a global story, but Northern Virginia has the largest portion. So naturally, that's where the infrastructure needs to move forward at the fastest pace.
Pavel, when I first learned about how utility grids worked, I was pretty surprised to learn that you can use both oil and natural gas, and sometimes natural gas can be cheaper in utility grids as well. There's a big conversation in the U.S. right now about exporting a lot of extra natural gas and LNG to Europe, but if you see this AI data center build out in the U.S., do those flows get redirected?
Natural gas going to Europe will be limited not so much by the ability of American gas producers to pump as much as they want, but rather by Europe's need to import LNG. And here's why I say that. Since Russia invaded Ukraine 3 years ago, Europe's consumption of natural gas is down by 15%. I'm not talking about down 15% from Russia. I mean, that's practically at zero. But overall, Europe is using 15% less natural gas. So guess what? That means less need for natural gas from any source, U.S., Qatar, Norway, and Azerbaijan, and so forth. So that's really where the constraint is going to come from.
So there's no necessarily relationship between the natural gas needs of Europe or the natural gas needs of other folks in the United States versus, say, the AI build-out?
We have plenty of natural gas in North America to do both. So natural gas will certainly play a role, particularly in the eastern half of the U.S., to support the data center boom. Now, in the western half of the country, as I said, AI is less of a factor. But keep in mind, we also need to replace coal plants that are being retired. And this is why we're going to be following an all-of-the-above strategy for the electricity mix. Natural gas, wind, solar, and in certain cases, and with also long lead times, nuclear as well.
I am curious, though, Pavel, do you think that, at least here in the U.S., that government policies coming out of this new administration will be supportive of some of those renewable energy initiatives like wind, solar, nuclear, et cetera?
Number one thing we need to understand about government policy as it relates to electric power is that it is predominantly at the state level rather than the federal level. Electric utilities are regulated by state-level utility commissions. There is a little bit of a role played by FERC and the Department of Energy in Washington, but number one is the state-level regulation. So here's an interesting fact for some of your listeners. 29 states have a renewable portfolio mandate for electric utilities, including, by the way, some red states like Texas, Missouri, and Montana.
Yeah, it'll be interesting to see whether that holds and how that interplay between those states and the federal government goes forward. I do want to ask you a much more straightforward question about the oil market and particularly about the mobility of oil. Obviously, there are a lot of concerns about geopolitical issues and the disruption of flows of oil. You have the wars obviously going on in the Middle East and elsewhere that have also disrupted the flow of oil. Do you see any sort of right-sizing in that next year, or are these sort of, I guess, issues that are going to just remain lingering for a good portion of the year?
For the past 12 months, we have had two major wars, Russia-Ukraine, and of course what's happening in the Middle East. Despite that, oil prices have barely moved since January 2024. Why? Because we also have to take into account what's going on with demand, and demand has been weaker than expected, in large part because of China. So number one question for next year is not so much geopolitics, it's good old-fashioned supply and demand. what's going on in China with the economy, and by the way, with electric vehicle sales. Half of China's auto sales are now electric. That's a big deal. We're also watching the dollar, strengthening dollar, as we have seen pressures commodity prices across the board, including oil. And the third thing we're watching is OPEC. OPEC has been very disciplined since COVID with supply. At some point in 2025, OPEC will begin to unwind its production cuts, which means more barrels on the market, and that may put some pressure on the price of oil as well.
All right, Pavel, great stuff. Pavel Molchanov over at Raymond James. A closer look here at the energy market, the outlook for 2025. We continue our coverage here on Bloomberg Surveillance to look at some of the big stories of the day going on out there. Let's get your Bloomberg brief. Yahaira Haka is joining us right now.
Hi, Romaine. Mortgage finance giants Fannie Mae and Freddie Mac saw their shares jump over 30% by yesterday's close, sparked by a post from Bill Ackman that stoked optimism that the companies will be released from conservatorship under Donald Trump's administration. Meanwhile, the U.S. government fund created to compensate victims of Bernard Madoff announced its 10th and final distribution this week. The government paid out $4.3 billion to nearly 41,000 people, schools, charities, and pension plans who were swindled by the Ponzi schemer. Victims recouped an average of 93.7% of their proven losses. And Hollywood studios are seeing an end-of-year surge at the box office, with projected ticket sales for the year inching closer to 2023's total. Through Sunday, domestic box office sales were at $8.66 billion, according to ComScore. The three-day weekend total of $165 million was led by Disney's Mufasa, Paramount's Sonic the Hedgehog 3, and Nosferatu from Focus Features. Domestic ticket sales are still below 2018's record-breaking $11.9 billion. That's the year Avengers Infinity War and Black Panther came out. Feels like a lifetime ago. That's your Bloomberg Brief. Romaine?
Yeah, absolutely. I haven't seen any of those movies. By the way, I got to get out a little bit more. Meanwhile, here on Bloomberg Surveillance, coming up next, the high cost of owning a home.
As we're looking into 2025, what we're expecting is that mortgage rates are probably going to be volatile, similar to what we've seen, but that they're probably also going to remain pretty high.
And of course, there are a lot of people out there who are, well, I guess, concerned about the cost of buying a home. And there are folks out there who, well, don't have any concerns at all. A conversation up ahead on the luxury real estate market. In fact, if you've bought luxury properties down in Florida anytime soon, you probably did it from one of our next guests. That's coming up next here on Bloomberg Surveillance.
Names in business are on Bloomberg.
We are in the midst of the largest wealth transfer in history right at this very moment. So $100 trillion of wealth is going to next-gen and millennial clients over the next decade. So that has some pretty significant implications. But in addition to that, women are controlling more and more global wealth. Today, they control a third of global wealth, but in the next 5 years, $30 trillion is going to pass in the hands of women, and they're going to control over 50% of the global wealth market out there today. Women care deeply about investing with purpose, investing to make an impact, doing good with their investments. So you're going to see some significant opportunities for us as we lean in and have been leaning in to capturing more of the female wallet globally.
Nobody covers business like Bloomberg. Context changes everything.
A continent of vast opportunity and endless potential, but not without its challenges. Bloomberg highlights the players and unpacks the issues shaping the African story. We'll bring you interviews with key newsmakers and expert analysis, getting to the heart of business, politics, and economics in the region. I'm Jennifer Zabasaja, and this is Africa Amplified.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg.
Welcome back to Bloomberg Surveillance. Quick check here on the markets. Futures pointing to a slightly higher open, but we should point out here, volume is going to be incredibly light, as it typically is here on the final trading days of the year. S&P futures up by about 0.3% here, a potential cap to a 24% run on a year-to-date basis. Not much action right now going on in the FX space. Euro dollar unchanged at the moment here, and we're keeping an eye on yields. 4.5% is where we're probably looking to close out the year. Not where most people expected. In fact, we came into this year with expectations to be a lot lower than 4.5%, and by the time we got to mid-year, the expectations were for us to be, well, a lot higher than 4.5%. You split the difference, a narrow trading range, that's what you get here for the Treasury market. A narrow trading range as well continues in the energy space. Oil futures here in New York, WTI crude 71 and change, up about 0.3% on the day, unchanged on a year-to-date basis. Of course, energy has been a big story of the year. So too has been real estate and the potential rebound that we've seen in a lot of those markets, particularly in the high-end market. And that is under surveillance this morning, the high cost of owning a home.
Mortgage rates for really the last couple of years has, bounced around a lot, but they've generally stayed pretty high, and we're ending the year with pretty high mortgage rates. As we're looking into 2025, what we're expecting is that mortgage rates are probably going to be volatile, similar to what we've seen, but that they're probably also going to remain pretty high. We don't really see a lot of room for rates to fall.
And despite those high mortgage rates, luxury real estate is booming. According to global luxury real estate brokerage, The Agency, those home sales rose just over 5% in the first half of 2024, while overall home sales dropped about 13%. Dina Goldentire is joining us right now. She's a real estate agent over at Douglas Elliman Real Estate, and honestly, one of the biggest brokers down in the Miami, South Florida area, responsible for billions of dollars worth of sales. Dina, I would assume your clients probably aren't too concerned about mortgage rates. They're going to buy whenever they want to buy. But I am curious about their sentiment right now. Are they feeling better about venturing into these purchases, at least better than maybe what they would have been a year or two ago?
2 years ago, they would have felt exceptionally good. 2022 has proven to be the peak of the post-COVID market in my neck of the woods, which is Miami and Miami Beach. But they still feel good about making a purchase that helps them establish roots in this exceptional city.
I am curious, when we talk about this exceptional city, we'd be remiss in not pointing out the huge migration of folks from places like New York, as well as other parts of the country, down to Miami. Some of that was because of the pandemic. Some of that actually started prior to the pandemic. Of course, we kind of call it Wall Street South now. A lot of demand for housing. Dina, is the supply there?
The supply is definitely there, which makes it a better time to be a buyer. During COVID, if you flew in, I would have maybe 3 homes to show you, and you'd be making a full price offer on one of them. Now I might have 10 homes to show you. You have more bargaining power. So buyers actually feel better out there because they can have more selection and they don't have to give in to every whim of a seller. For example, there used to be this commonplace term that I would have to add into my contracts that would allow a seller to stay back, have your money, use it to buy something else, and very rarely pay you rent. Now, as we approach 2025, buyers don't have to offer those types of terms to sellers. Things just can be more normal.
Well, Dina, talk to us a little bit about maybe that dynamic Romain was talking about. I know, again, mortgage rates, maybe there's a little bit of kind of elasticity there with your clientele. But in terms of leverage, are you seeing changes in leverage that people are willing to take out or use to finance some of those buyings?
So in the $440 million in sales that I did this year, 0 had financing.
Oh, well, that says something, certainly. Talk to us about the kind of clientele, though. I mean, again, Romain was talking about from New York to Miami. What about international buyers? Are they driving up some of those property prices?
The biggest international buyer that I'm seeing in my marketplace are the Canadians, and we tend to loop them in as one of us, but they are in fact the biggest international buyer for my book of business.
I love the Canadians, Dina, but they're not one of us.
They're nice.
Yeah, they're very nice. I am curious though too, and just going back to Miami for a second. I mean, I've been to Miami many times. I've been to all the neighborhoods except for one. I've never set foot over there in Indian Creek for obvious reasons. One of the most exclusive real estate enclaves in the country, if not the world here. What's going on over there? I heard Jeff Bezos, right? He's building like, what, another mansion? And then isn't there a property next to him that apparently somebody's snatching up for a couple $100 million? What's going on out there?
I mean, Indian Creek is the sexiest destination in the country. I've had the pleasure of selling several homes there. You know, Jeff Bezos obviously has put it on the map, but Tom Brady was there before, and he's always posting on his Instagram from his beautiful backyard. Oh, I sold that one. It's really spectacular, and it's like nothing else, and it is Billionaire's Bunker, but it's also gotten younger. The buyer for Indian Creek is no longer necessarily someone who is in their 70s or 80s. You know, you've got plenty of owners in their 40s on the island, and it's an incredible place, and I'd love to take you there if you're ever in town.
All right, well, I may actually take you up on that at some point, Dina, but before we get there, I'm curious. I mean, it's interesting you talk about the younger buyers, too. I am curious as to whether the younger buyers, and we're talking wealthier buyers here, whether they gravitate to the same neighborhoods that kind of the older money did. I mean, you kind of saw a big transition in New York where, you know, the Upper East Side was, you know, basically the bee's knees for everybody. And then you had this sort of new cohort of tech entrepreneurs and other people that said, I'd rather be downtown in Tribeca or somewhere a little hipper here. Do you see the same trend in Miami, or are they gravitating to those old money enclaves as well?
That's an excellent question. I've never heard of that juxtaposition, but we definitely have that in our marketplace. You've got kind of the people who would choose the Upper East Side in New York. They tend to gravitate to Surfside, Bal Harbor. You've got people who would choose Tribeca or Soho. They gravitate more towards the South Beach and South of Fifth area. And then the tech money, they love the Venetian Islands. But to also answer your question, yes, new money loves the same thing as old money. They love Fisher Island. They love Indian Creek. They love being there in their 40s. When it used to be only for people in their 70s or 80s. Luckily, we have enough of a buyer pool to support all these incredible neighborhoods.
All right, Dina, great stuff. And obviously you have some great insights into what's going on down there. $3 billion in sales just since 2021 alone, $450 million. It's hard to believe just this year. Congratulations on your success. We'll catch up with you next year in 2025. Dina Golden-Tayer over at Douglas Elliman Real Estate here, Creedy. And I was also taking a look. One of the biggest sales that we had this year down there was actually the Beckhams. $72 million property they purchased over there on North Bay Road. And you know what I love about them? Aren't they British?
Tell me.
Aren't they one of you now? Yeah.
Oh, am I British now? Can you tell from the accent? Look, I don't know if the British would want me, but I think it's important to keep in mind that that's not just the Beckhams, it's Lionel Messi as well. He now lives there. He's driven some of the property prices up. I hear he's potentially making some of his assets into a REIT as well. So I don't know, something's going on with Miami, but then I hear so many people are leaving for Austin, Texas, or San Francisco, or Seattle. So I don't know, Romaine, what's the new Miami?
I don't know. I mean, that's a big, I wish I knew. I mean, I wish I had gotten in on the new Miami when it was the old Miami, or the new Austin when it was the old Austin, or whatever, but it'll pop up somewhere. I was also curious too, I mean, just kind of speaking of kind of the wealthy and the celebrities, did you know that Brad Pitt and Angelina Jolie got divorced? Which was surprising to me because I thought they got divorced like 10 years ago. But apparently this has been like an 8-year-long divorce process that apparently has now just been finalized and basically going down as one of the longest and most contentious divorces, at least according to the Associated Press.
We're finally talking about the stuff I want to talk about, the real news you can use, I think, Romaine, which is basically, and I think I know way too much about this custody battle or this kind of divorce than I should, because I believe a winery was a big part of the conversation, a winery that they had a joint ownership of, and I admit I have not read into the latest of who got the winery, but I hear it was a very contentious piece of property.
Yeah, I mean, anytime you have these types of celebrities and that type of wealth and the type of assets, it's always a bit complicated to kind of sort it all out. But 8 years? Oh, my gosh. All right, Critty, we got a lot more to talk about here on the big program. And actually, I just want to say, I mean, Critty's actually going to be leaving us. So I just want to say, Happy New Year to you, Critty. Thanks for being here on Bloomberg Surveillance this morning. The final hour will be taken over by Shanali Basak, but we'll talk plenty next year. Our thanks there to Critty Gupta as we say goodbye to her. Stick with us here on Bloomberg Surveillance. A lot of big guests up ahead, including Matt Miskin over at John Hancock, Tom Fitzgerald at TD Cowen, and Danielle DiMartino Booth. Talk about here the future of the Fed. And how about this? A ball drop here in New York City, and of course a focus on security, a conversation with former NYPD Commissioner Ray Kelly. You're watching Bloomberg Surveillance.
I think we got a lot better at how we allocate among these geeky equity factors. We've gotten a lot more systematic. For our first 20 or so years, it was probably me and a handful of people saying, what's a reasonable long-term allocation, and we stuck to it. Not to get into an AI kind of theme, but we let the machine decide more. And it took me a while. I probably slowed us down 2 years on this, because I think it's my job as an old man at the firm to kind of say, you're going to change to what? But I'm reasonably convinced it's just at least a little bit better than us. We did price trends since I wrote my dissertation in the late 80s and early 90s. But in the last 5 years, a tremendous weight not just to price, which it was historically, but to fundamental trends. Tremendous exposure to more esoteric trends than just your famous stocks, bonds, currencies, and commodities.
Like what?
Suddenly, I'm walking around and somebody is talking about trading milk, and somebody's talking about trading sugar, and somebody's talking about trading my favorite, Malaysian palm oil. We found the sweat equity of pushing into newer markets. They're smaller capacity, in basic value investing around the world, and value in a broader sense than just quant multiples, considering quality, more of a Graham and Dodd sense. You can run an awfully lot of money.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
talked about how governments are not looking at healthcare and investing in healthcare as much as they should. What's the message you'd like to send to those governments?
Well, I think a healthier population is always going to be more productive. It's just that sometimes the political will isn't there in some of these countries. So I hope that they can keep this as a priority, because a workforce that is 20 or 30% down during a pandemic or an outbreak, or there's certain diseases that keep spreading, is not healthy, it's not productive. And if you want everyone to perform at their best and you want healthcare costs to be down, you don't want to be burdened with insurance costs and other costs, I think it's important to invest early in health, in child health, in women's health, and I hope that continues both in India and other parts.
In case you missed it, on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Shonali Bassick.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
Is seeing that the economy is not weak.
We're getting to a point where equity risk premiums are incredibly narrow.
I don't know what to expect, but I'm not really sure if markets really know what to expect. I think that creates some volatility.
There's quite a lot of momentum still to be had, particularly in the first half of next year.
As goes January, so goes the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
8 a.m. in New York, 3 p.m. in Jerusalem, midnight in Sydney, Australia. Happy New Year to our audiences worldwide. Good morning. This is Bloomberg Surveillance. Romaine Bostic here in Bloomberg World Headquarters in New York, joined for this hour by Shonali Bassick. Happy New Year, Shonali.
Happy New Year to you.
People already celebrating around the globe. You got big plans for tonight?
No big plans, but my parents are in India, so they'll be celebrating soon as well. So exciting to see it happen all across the globe. I do feel sentimental.
Yeah, I mean, I always like this. I never really stay up to midnight because I'm one of these early birds. I go to bed early, but we are going out this afternoon. My whole family's here, and we're gonna have a little bit of fun, and then hopefully I can get to bed before.
I will be in bed the minute after the clock turns into the new year.
All right. Well, a lot of people in bed. We should point out volume is light here in U.S. markets here with just about an hour and a half until we get to the cash session. Let's check in on futures right now. Stock futures up about 0.2% on the S&P. Similar moves, quite frankly, on the other futures as well. The Dow, the NASDAQ, and the Russell 2000. An interesting punctuation mark here for a market that is sitting on some really sizable gains. The S&P, Shonali, headed for its 5th straight quarterly gain, 24% rally on the year. That matches the gains that we saw last year. It was also about 24%. That's the best 2-year gain going back to 97, 98.
It's certainly a historic run we've really seen here, but we remember what happened in 97, 98. Going into the new year, you do have some jitters. The S&P 500 breaking those 3 days of losses, significant sell-off just yesterday. If you told me we'd be sitting here in the last day of the year and the 10-year yield was more than 10 basis points lower than where we saw it Friday, tremendous bond market volatility in addition to the stocks.
And think about where it was at the beginning of the year or even a year ago. And it's kind of interesting, like, what is the most surprising story? Was it the record moves in stocks? Was it kind of the non-record moves in commodities? Was it what we saw in the treasury space? Was it just the VIX and the fact that it did nothing this year?
Or frankly, Bitcoin 100. Would you have put that on your bingo card after FTX and the way we bounced back?
I was ready to stop talking about Bitcoin earlier this year, and then all of a sudden it roared back here. Of course, now sitting on a 100% gain on a year-to-date basis. 100% gain the previous year. You got a lot of folks thinking it can match those gains here in 2025.
Certainly everyone's setting up for a new administration as well. And while there are some jitters in the bond market, you saw Bitcoin really tearing off the heels of this idea that the SEC will be a little lighter. We'll see. Everyone's preparing for inauguration. We're 20 days away.
A lot of catalysts out there that could move the markets. A lot to talk about in this final hour of Bloomberg Surveillance. Matt Miskin over at John Hancock going going to be stopping by on why he sees limited upside for the S&P after 3 straight years of gains. Tom Fitzgerald over at TD Cowen is going to provide his 2025 outlook for the airline industry. In fact, airline and travel stocks have had a phenomenal year. And we're going to talk to former NYPD Commissioner Ray Kelly about keeping everybody safe as the city of New York gears up for those big New Year's Eve celebrations. The ball drop. Have you ever done the ball drop in Times Square?
I have not.
Yeah.
I've watched it safely from downtown or uptown, wherever I've lived at the time.
Yeah.
I'm out of the city this year.
I was fortunate enough to actually see it before all the security really ramped up, before 9/11, before the Oklahoma City and all that, where you can just kind of come back and forth.
What year?
And kind of that. I'm older than I look, Shonali Bassick, so that's going to keep that close to the vest here. We'll not be going out tonight, but for all of you out there braving it, we wish you the best. We begin this hour, though, with equity futures sitting on modest gains. Stocks hoping to snap a 3-day losing streak here on the final trading day of 2024. The S&P having a wonderful year, a blistering year. The index up about 24%. Matt Michigan over John Hancock seeing a limit, though, to further gains, writing that it's going to be hard for equities to stomach much more upside. While we still prefer U.S. equities based on the better fundamentals, we recognize the magnitude of outperformance in 2024 is not likely to be replicated. Matt joins us right now to talk a little bit more about that outlook. And Matt, maybe we don't see the same gains we saw in 2023 and in 2024, but should we expect at least some meaningful gains in 2025?
It's certainly possible, Romaine, but what we're seeing here is heavy is the crown, really, for U.S. equity leadership and U.S. economic leadership, frankly. After certain stints like this, where U.S. economy has just blown past most global economies, the U.S. dollar has strengthened a lot. So it's up about 6% in 2024. A stronger dollar makes us less competitive on a global basis. It helps actually bring down inflation because we're buying stuff from abroad, but it is difficult to stomach for economic purposes. Then rates have been higher. So we have high quality bond yields, 10-year yields higher on the year. That's a bit of a slowdown. And then there's massive expectations out of the U.S. economy and markets into 2025. So the earnings estimates for 2025 for the S&P 500 are still about 15%. So there's a lot of optimism. One of the biggest assets the S&P 500 and U.S. large cap stocks have had over the last several years has been conservative and more kind of bearish sentiment. Mm-hmm. The sentiment dial has been turned up significantly to end 2024. We think that's becoming a bit of a liability as we walk into next year.
Well, that's what I am confused about here. We talk about how crowded some of these trades are. We talk about the lack of hedging that we're seeing in the equity space, and the idea that you have valuations, at least for some of these companies, that, at least by historical standards, would be stretched. I know there are some people that want to reinterpret history, but what do you do in that situation? Do you reallocate? Do you stand by your conviction that maybe some of those stocks can go higher? What?
Yeah, momentum is not a fundamental factor, and momentum was the number one way to outperform, the only way to outperform, frankly, in 2024. So what is momentum? It means you look at the best performing stocks over the last 6 to 12 months, and you allocate the most to those. So basically, chasing performance was rewarded in 2024. But to your point, Romaine, there's other things that drive stock markets, whether it's valuations, whether it's earnings. And those parts of the market have been left behind this year. And there's a bit of a dogs of the Dow type formula where usually the worst performers can sometimes become the best performers in the subsequent year. This year, ending this year, the dogs of the Dow kind of mantra looks more realistic as a potential turnaround or catalyst into 2025 because we are so stretched on the valuations. We're at about 22 times on forward PE on the S&P 500, the highest in history, at least the last 30 years has been 24. There's about 9% upside we can get on valuations. Earnings estimates are already great. Dividend yields are the lowest in history. So to your point, it's hard to eke out gains in the more expensive stuff. The better value stuff could come around.
Why do you believe that in the essence of when you see sell-offs happening, you're seeing a lot of babies thrown out with the bathwater here? And if you believe that maybe some of these underperformers can come back next year, how much of a risk is there that just risk appetite alone goes along with it?
Yeah, that's the tide that lifts all boats and the risk appetite. But what we're seeing, look, is into next year, there's just hard to get more valuation upside on the other parts. It's not necessarily calling that they're bad companies, that they're going to see this, really bad performance. It's more just saying the multiples can expand in more like mid-cap stocks and small-cap stocks versus large-cap stocks. Internationally also has been really a tough performance year. European equities are only up about 2% in US dollar basis. They're very cheap still. So what we could see is just a rotation, or even, I would say, downside protection, because the valuations are so much more attractive. So those are the types. We're just trying to manage risk the best we can. And frankly, the high flyers don't look good to us because of the valuations. And part of the value space that's deep value, the earnings aren't as good. We're trying to apply quality at a reasonable price as our mantra into 2025.
So then is the best way to hedge the equity market, in essence, the equity market? Because if you're looking at the volatility in the bond market, is that really a place to go hide?
We think it will be into 2025. Inflation is likely to come down. Inflation is the nemesis of that bond market inverse correlation, really, that hasn't been around for the last year or two. But inflation has come back a bit to end the year. We think that's more sentiment driven. We do think that comes back down into 2025. And really, it goes back to housing. I mean, we're going to get some housing price data today. We're really dialed into mortgage apps, housing price data. Housing made up about 60 to 70% of the inflation narrative over the last several years. If that can slow down into 2025, inflation comes down, bonds act like bonds again. And if that happens, a balanced portfolio really can look much better from a diversification benefit standpoint into next year.
Matt, I want to go back to something you just said. It kind of startled me. One of the great things about having a Bloomberg terminal in front of me is I can kind of check everything on the fly. About dogs of the Dow. They were dogs all year long here. I mean, I was just taking a look at the dogs coming into this year. We're talking about underperformance by about, 25 percentage points relative to the S&P 500, just to use that as a comparison. And I'm looking at some of the ones that will probably be the dogs going into next year. I guess the ones with the highest dividend yields, like Verizon, Chevron, Amgen, and Johnson & Johnson, to say the least. I mean, some of these names were the same dogs coming into this year, and I am curious as to whether this is also about sentiment and attention. If all the attention is on tech and AI and other things, like, why should I expect anyone to really embrace a healthcare stock, or even just a consumer staple stock, or a telecom stock?
Yeah, so momentum, like I said, was the best performer, and all the other factors did not work. So you had to chase performance. If this is not a year of a rotation, it's got to be the 1990s all over again. So there's only been 3 other times where there's been 25% back-to-back gains, like we're looking at here potentially. The only time it went 3 years in a row was in 1999. So we're going to have to kind of bring out the popcorn, watch maybe some Jurassic Park or Friends, or we're going to have to get our 90s culture back. But 1999, you got to be careful what you wish for, because if we do get that third year where it's this another momentum year, it's going to be tough, because then you got to be careful what you wish for, because then we got the last decade after that. So we would start to peel back that momentum trade and rotate into higher quality but value parts of the market.
I mean, one thing, though, too, about the comparison with the 90s, and a lot of people will make this comparison, which is the idea that in the 90s you were dealing with a lot of companies that just did not necessarily have the fundamentals to support those valuations. We talk about a market, and I checked it this morning, 70% of the gains, the point gains in the S&P 500, attributed pretty much now to about 9 stocks, basically the Mag 7 and a couple on top of that. But all of these are names that are just cash monsters: NVIDIA, Apple, Amazon, Broadcom, Meta, Tesla, Microsoft, Alphabet, JP Morgan, Netflix. Those are winners, man.
I agree. No, we've been overweight tech. We've got that, but it's just hard to see the same kind of return stream that we've gotten out of them into next year. You can only do outsized return. There is reversion of the mean over time, usually with markets, and we are in the most concentrated market in history by a huge factor. So 40% of the market is just in those top 10 stocks, and I'm talking about the S&P 500. That's never happened before. It's never even been close to this high before. So reversion of the mean would suggest that at some point those trillion-dollar mega cap companies have already built in the valuation to those great cash flows. I'm not saying, look, we've got it in the portfolio. We've got a bit of an overweight relative to other parts of the market. Yeah. But going into next year, chasing that doesn't make a lot of sense to us. Finding other opportunities across the portfolio, other asset classes, makes more sense in our view.
Matt Miskin over at John Hancock. Happy New Year to you. We'll catch up with you in 2025. And Shanali, it's kind of interesting, too, to see how the market rally has changed. On a year-to-date basis, 10 of the 11 S&P sectors higher. But when you look at it on a month-to-date basis or even a quarter-date basis, only 3 are in the green, and that's communications, discretionary, and technology.
Some of the dogs of the S&P are expected to be dogs of tomorrow, or the winners of tomorrow. Think energy, for example. A lot of people riding on that trade heading into the Trump administration.
One of the surprising performances on a sector basis this year was in the travel sector. When we come back, we're going to talk to Tom Fitzgerald over at TD Cowen about his outlook for the airline industry in the new year. And we are now in the new year in certain parts of the world. Happy New Year. This is Bloomberg Surveillance.
We spent some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Surveillance. Futures pointing to a slightly higher open here on this final trading day of the year. 0.3% gain for S&P futures. Similar moves across the rest of the equity space with just a little more than an hour to go before we get to that cash session here. Interesting to see how we close out the year for an S&P, a NASDAQ sitting on what are near record highs right now. A phenomenal year. 20+% gains, almost 30% on the NASDAQ, Shanali.
That S&P 500 trying to edge back into that 6,000 territory. That's where it really wants to end the year, Romaine. And it's so interesting to see also volatility come back just a little bit. And people like Matt Miskin over at John Hancock watching that economic data till the very end.
And we talk about that equity market and kind of what moves it. I mean, it was all about tech, right? It was all about AI. It was all about, well, I don't know, chips, right? Philadelphia Semiconductor Index up 20% on a year. The Mag 7 having a pretty decent year as well. Discretionary stocks up 30%. But guess what, Shanali? One of the best performing sectors out there, believe it or not, airline stocks. The S&P 1500 airline index up 57% this year. You talk about this annual performance here on the year in S&P Super Composite Airlines Index. Now, a lot of questions here about whether that momentum can continue into the new year. Tom Fitzgerald of TD Cowen joining us right now to talk a little bit more about his outlook here. And I was just taking a look at some of the data here that Bloomberg has been tracking here. They've gotten new survey data from some of the main lobbying groups. Expectations that we're going to see net income continuing to rise next year for the airline industry. Profit margins continuing to widen next year for the airline industry. Pricing power to widen in 2025 for the airline industry. Tom, what's your outlook?
I would agree with that. We think the industry has a lot of momentum as we head into 2025. Demand is still healthy. The traveling public skews higher income, which is very positive for the industry. And supply looks set to remain constrained through next year in 2026. So and fuel prices are manageable. So that's all very favorable for margins, lowering earnings volatility, and generating substantial cash flow to help the industry leaders de-risk their balance sheets.
What is sort of the balance of demand right now? We kind of went through this period coming out of the pandemic where it was very heavily weighted towards leisure travel. Business travel did seem to come back a little bit this year. What does that demand balance look like in 2025?
Leisure is still really strong, and we think corporate travel, we're not expecting a massive step change in the new year, but we're expecting continued recovery, especially if there's an uptick in capital markets activity, advisory activity, deals, and so forth. That should be very supportive of managed corporate travel, which has been the slowest segment within corporate to recover. Small and medium-sized business travel is well above pre-COVID levels.
When you think about some of the pressures and the big changes that have happened in the industry, you think about the troubles faced by Spirit, for example. You think about failed mergers trying to inch their way back. What does the industry look like next year in terms of the winners and losers? Are you going to see some of the more traditional airlines gain even more steam, given the shakeout we've been seeing? Say United Airlines and American.
Yeah, exactly. We think that's likely. The profit laggards, the low cost and ultra low cost carriers, they're going to be seeing flat or even shrinking growth next year, while the industry leaders are going to be growing in line, or in the case of a United, growing above GDP. So that creates a great opportunity for them to continue to take share, especially in the domestic market where we're seeing a lot of the pricing momentum, because that's where the excess supply was over the summer.
And I would love for you to respond to some of these pressures that we're seeing as outlined by Bloomberg Intelligence. This idea that you could still see rising wage costs, especially from pilots. You could see moderating capacity growth, and then you have that industry shakeout we've been talking about. Wouldn't this all lead to higher prices for consumers? And if so, how much?
It should. The cost pressures are real, and that's why we favor airlines like United, Alaska, Delta, who have the diverse revenue streams to offset some of this cost inflation. And you don't have, typically when there's discounting wars, it's when profitability was starting from a point of strength. So you had the room to cheat a little bit on pricing to try to take share. That's not the case today. So, we're not expecting eye-popping gains next year like in summer 2022, but we should have steady pricing gains and pretty strong unit revenue growth.
What about how they mix up the seating arrangements? We saw a lot this year with more airlines experimenting with, I guess, premium seating, if you will, basically taking what I guess would normally be economy seats, making them wider or more leg room so they can charge a little bit more. What has been the uptake on that? Have consumers been receptive to that?
I think it's still early days. We've seen Frontier and Spirit go up market with some similar, maybe more akin to a domestic first class, but it's still early days on their results. And over the coming year, we'll see Alaska and JetBlue reconfigure their cabins to Alaska to retrofit some of their domestic first class offerings, and JetBlue to finally introduce a domestic first class offering. So, Southwest won't even have extra legroom until 2026. So it's going to take some time to see how this upmarket strategy plays out. But the premium demand is there, so it's very, very appealing time for Uniteds and Deltas of the world to capture that demand right now.
I am curious. One sort of interesting element to the rally that we saw this year in some of the stocks, particularly over the last couple of months, has been this idea of a somewhat lighter regulatory touch coming out of Washington in 2025, particularly against the backdrop of a couple of mergers that, of course, did not happen for a variety of reasons. And I am curious if you anticipate the potential for consolidation in the airline space, the U.S. airline space, next year and beyond.
It's definitely possible given the change in the administration, as you mentioned. I think, people in the industry that we speak to wouldn't be shocked if there was consolidation among some of the low-cost or ultra-low-cost carriers in the years to come. I think you can point to the benefits that it had for the hub and spoke carriers over the last 15 years. So I think there's a case to be made that consolidation could help some of these smaller players gain scale and just have one national spill carrier versus a couple carriers chasing that price-sensitive traffic.
One national carrier. I mean, that is kind of a dream that the industry has been heading towards. Again, not always the greatest for consumers, especially when so many of them are really ticking up here on fares and also on those luxury seats, as Romaine has been talking about. What's the ultimate consumer impact on this, and is there a consumer protection behind it?
I think that's tricky to say. Overall, people are still, they value travel. I think there's a lot of options. You don't have to pay up for the front of the cabin. You can redeem points if you have the credit card or the mileage program. So at the end of the day, as long as the economy is healthy, demand for travel tends to be somewhat inelastic. So I think people will just grin and bear it. They'd love to have deals, but at the end of the day, I don't think they're going to not have the experience, not see their families, not take the business trip.
So what do we think about the actual investor perspective here heading into next year? We started on how this was such a great trade this year. In your coverage universe, what has the most upside of the stocks that you're looking at?
United remains our best idea. So there's a rising tide that's lifting many in the industry, but they have so many idiosyncratic tailwinds. They have the largest international franchise. They have a vastly improved domestic network. And we think they're set to reap the benefits of some really savvy investments that the management team made, both on the fleet side and on the technology side, with the Starlink Wi-Fi installation over the next year and their connective media ad platform down the road in 26.
All right, Tom, great stuff. Got to leave it there. Tom Fitzgerald over at TD Cowen, an interesting outlook for the airline industry. And Shanali, it's funny, he points out United Airlines. I didn't realize that's not doubled this year, more than doubled. In fact, it's the fourth best performer in the S&P 500 this year. And in fact, travel stocks overall did incredibly well this year.
It's interesting because when you look at the travel stocks, you would think that they're all kind of in the larger consumer sector. But given the airlines, they're categorized, of course, as industrials. We talk about this a lot on Open Interest as well, because if you could buy it as a block trade, right, then wouldn't you be able to benefit? If you think about the dogs of the Dow, like Matt Miskin was talking about, then maybe you even look even further outside to the hotels as well.
They've done well. The cruise lines have done well. United, 138% gain. SkyWest, 93%. Alaska, 66%. Now, some of these stocks are coming, of course, off some very low lows from last year. But still, if you just came into this year and thought, okay, I'm going to double my money on an airline, you would have been crazy, right?
Yeah, and especially if you were worried about the consumer.
I am crazy, but,
We're all a little crazy. Right. Otherwise, we'd all go insane, so they say. But, if you came into this year, you were worried about the consumer. People are still worried about the consumer to the point you made just yesterday that delinquencies are rising once again.
But they keep spending.
They keep spending.
And I know at some point we're going to have this reckoning with that spending, but for now, like I said, you've seen the holiday shopping numbers, you've seen the travel numbers. People just continue to spend money.
People might have disinflation in some areas or lower inflation, but it looks like prices will be higher for airlines at least.
Well, of course, this might be an issue for the Fed as we head into 2025. When we come back, a conversation with Danielle DiMartino Booth over at QI Research. A look ahead to the Fed's rate path. Is it a path at all? This is Bloomberg Surveillance.
themes that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Welcome back to Bloomberg Surveillance. Futures pointing to a slightly higher open for the S&P, the Dow, the NASDAQ, and the Russell 2000, capping what has been a phenomenal year, really, across the board, and one that defied a lot of expectations, not just the 20% plus gain on the S&P, 30% gain for the NASDAQ, but even the Russell 2000 getting a 10% gain, maybe not as much as some people thought. I think some people thought we're going to see a much more of a broadening of the rally, but still nothing to sneeze at there.
Nothing to sneeze at. However, snapping days of losses for the markets here is a sigh of relief. Heading into the new year, people can sleep a little easy and recalibrate how they're going to think about risk into the new year.
Yields across the board in the Treasury market are lower, though we should point out higher on a year-to-date basis. Remember, that 10-year yield at one point was below 4%. Looks like it's going to end the year right around, Shanali, 4.5%.
It's just incredible because I guess that's better than 4.6% where we were last week, but certainly still more economic data ahead, including payrolls in a number of days, really.
What goes on in the Treasury market will drive potentially what goes on in the stock market. So too will the FX market. Take a look at the dollar, euro dollar unchanged on the day, but on the year. We talk about that dollar outperformance, that dollar dominance. Dollar is king, and that's going to be a big factor, not only in financial markets, but of course, what's going on down in Washington in the fiscal situation.
And you've seen the dollar drift higher even with the yield movement moving lower in the last couple of days. So you're seeing somewhat of a decoupling, I suppose. But of course, there's going to be a lot of factors heading into that, including what happens both not only with issuance, I know we're going to talk about that, but also in Congress.
All right, under surveillance this morning, a look at the Treasury Department, which has now confirmed that it was indeed hacked by a Chinese state-sponsored actor in what it describes as a major cybersecurity incident. The hacker allegedly accessed several workstations and an unknown number of unclassified documents, the latest of what's been a series of cyber espionage incidents involving China targeting the U.S.
You know, I think back to a conversation I had with Marty Chavez, who was the CFO of Goldman and now at 6th Street, and he's also a very large technologist. His biggest fear, Romaine, was an attack on the Treasury Department. And why, of course, it's because it's the most critical lifeblood to the financial markets. Of course, we did not see those immediate effects. This was a breach that was reported by a third-party software provider to the Treasury Department on December 8th. We're hearing about it on December 30th. So we don't know the extent of what has become of it, but of course it's not the first time we've seen such a hack, although to the Treasury Department it tends to hit a specific nerve given it is the backbone to the financial system.
Absolutely. Here, I'll also keeping an eye on, well, House Speaker Mike Johnson, President-elect Donald Trump, giving his full endorsement for Johnson to remain Speaker in the new Congress. And he's also getting an endorsement from, well, none other than Elon Musk, who, of course, helped to finance much of Donald Trump's campaign. Now, maybe this staves off a potential leadership fight in the chamber. The Constitution requires that this vote take place on January 3rd. And we should point out, he only needs a majority of the vote in Congress, but given how slim the Republican majority is in Congress and the fact that several Republicans, as many as 40, apparently have some issues with him, there's no guarantee he's going to get reelected.
Certainly having a vote of confidence from the president-elect helps in terms of getting certain things done. We know that speaker vote, of course, as you said, is Friday, but there are more dates coming up. You think about the Treasury Department saying that the debt limit will be reached right around inauguration. And so a lot to watch for this January alone, and a lot that will require congressional weigh-in. Perhaps the president-elect wants somebody more on his side.
And we will have full coverage, of course, of that vote as it takes place, scheduled by constitutional law for January 3rd. Meanwhile, we're also keeping an eye on the commercial aviation industry, which is now about to log its deadliest year since 2018. Most of this is related, of course, to 2 fatal accidents that occurred just over the last week alone. You have that crash in Azerbaijan, you have that crash in South Korea, in total taking the lives of 318 people. That's a reversal from 2023, which is one of the safest years in history for air travel.
It's wonderfully sad, of course. A lot of eyes on the airline industry and a lot of eyes on Boeing, of course, so it's not clear exactly what caused the crash. We know that our own Bloomberg intelligence analysts don't believe that it is Boeing. It's unclear what role the birds played here as well, but certainly a lot of eyes on what happened here and a very sad situation.
Yeah, and obviously it comes at a weird time for South Korea, which is dealing with its own leadership issues, and arrest warrant coming down for President Yoon a little bit earlier after what was at least being characterized as a coup attempt here. And that puts geopolitics back into the focus for everyone out there, including here in the U.S. and, well, even for the Fed. I mean, Jay Powell may not want to talk about it, but, well, he's got to at least think about it, because the markets certainly are. They are expecting fewer rate cuts next year, primarily because of a lot of questions about the impact of President-elect Donald Trump's policies. Danielle DiMartino Booth over at QI Research writing that the good news for the Fed is that after a spate of base effects that have the potential to put upward pressure on inflation, the direction towards that 2% target is assured. Danielle joins us right now. Pleased to see you. Happy New Year, Danielle. Let's talk about that 2% target. I'm still waiting on it. I know we're way closer to it than where we were a couple years ago when we were at like 9% on a headline CPI. But, you know, you take a look at the PCE data, we're still in that 3% range. What gets us down to 2%?
You know, it's really fascinating. In the last press conference that Chair Powell had, he had a very inarticulate sentence. He said, "Market rents is new leases," and I quote directly. Throughout the conference, he kept mentioning markets-based PCE, and this is something that you can track on the Bloomberg terminal, and what it really does is follow market prices to a much greater degree than what a lot of the imputations reveal in the Consumer Price Index or in the PCE. And he actually went into a very long discussion about markets-based PCE. That came in at 2% year over year on the dime in November, and even at the core level was a few tenths of a percentage point above that. And that's including the fact that this one markets-based measure uses owner's equivalent rent, which we know is an imputation. If you use the Cleveland Fed's rent metric, it actually comes in spot on. Core PCE markets-based at 2%. And I'm just intrigued that Powell is willing to look at some different measures to give him assurance that they're headed towards that 2% target.
I thought that was interesting, too. And I mean, look, I'm not going to second guess the guy. He's obviously a lot smarter than me on this particular topic. But we have seen a lot more dissension, if you will, amongst the FOMC members, not only just behind closed doors in the minutes that we get, but also we've seen that, you know, publicly in their speeches here, which I guess is understandable given that we are kind of at this inflection point with rates and no one really knows where we're going to go. So of course you're going to have some disagreement. But how much does that disagreement then become a limiting factor? Does it hold the Fed back from maybe making any sort of changes?
Well, you know, it's an extremely interesting dynamic, right? We had Susan Bowman dissent, the first Federal Reserve Board governor to dissent since Mark Olson did in 2005. So that was kind of an unusual development for 2024. Coming into the January 29th vote, we've got Collins and Goolsbee. They're considered to be doves. Then you've got St. Louis coming on and Kansas City. Those two gentlemen are considered to be fairly hawkish. So you really are going to have the chances, and I think Chair Powell knows this, that there could be dissents on either side of the dovish hawkish spectrum going into 2025. There's a lot to balance, especially because continuing claims really are stubbornly at a 3-year high. And as we saw on the terminal yesterday, large bankruptcies coming in at 18 for the month of December, the worst December since 2009. We really haven't seen a dissipation in that bankruptcy cycle throughout 2024. In fact, it looks to be ramping up into 2025. So there's going to be a lot for him to balance on the committee and with incoming economic data, as well as that coming out of the financial markets in corporate America.
I'm glad you brought up the bankruptcy cycle. I, too, have been watching it very closely. BCY on your Bloomberg terminal brings you the bankruptcies that you've seen this year, and the overwhelming kind of amount here, at least a fifth, really. You don't really have anything as close to it as in the consumer discretionary sector, a place where we've seen massive bifurcation. What does this mean? Is this kind of acknowledgement here that you're still seeing a bit of a K-shape when it comes to the consumer? And is there anything that both the Fed or policymakers can do about it?
Well, I mean, we really are getting to the crux of the inequality divide. And I think one of the greater challenges moving into 2025 is that the top of the K is about to get a little bit smaller. Many Americans, about 20 million Americans, have not made a payment on their student loans since March of 2020. So it's been almost 5 years here. And these are some of the higher income earners as well. And they're just now, tomorrow, for the first time, going to be reported if they're in default. So you can actually see one of the upper parts of the K start to weaken going into 2025. And I think that is, again, going to be a greater challenge for the Federal Reserve, because we won't be as bifurcated as we'll be really bottom weighted with people who have run through the credit they can run through, whether you're talking about buy now, pay later, which is on course to be 1/10 of credit card outstanding. It's on course to cross $100 billion early on in 2025. And so the idea of a spent U.S. consumer, while some higher income individuals who did not, they didn't qualify for for student loan forgiveness, they're also going to get dinged. And these are debts that cannot be expunged in the bankruptcy courts. And I think that's one of the reasons we're seeing an acceleration on the household bankruptcy side as well.
Danielle, I have a feeling we'll be talking about this a lot heading into 2025. But before we even get there, really, I want to kind of play into hindsight capital for a moment, because at the end of last year, on December 31st, when most of the markets were expecting here more than 6 rate cuts this year, I went back, listened to a podcast that you had done with us late last year. You were expecting 3. And so if you kind of take your crystal ball and bring it into next year, how many do you expect? And do you think that even a hike could be on the table depending how the presidential policies play out?
Well, given the magnitude of the revisions, for example, the Bureau of Economic Analysis took down its estimate of personal income for the second quarter of 2024 to $65 billion. It took it down by $91 billion for that one quarter. Given the magnitude of the revisions that we're seeing coming in, I actually think market pricing is in the wrong place this year, but in a different direction. I think we'll see probably more along the lines of 4, if not 5, rate cuts into 2025. We're starting the year with the median duration of unemployment at 10.5 weeks. It wasn't until, I think, October of 2009, during the Great Depression, that we had seen people out of work for such an extended period of time. I actually think the Fed's going to be leaning harder on its labor mandate going into 2025, and that the market's going to end up seeing more rate cuts than what is priced in right now, kind of a flip side of last year.
We only have about 1 minute left, Danielle, but I just want to get your thoughts here. Just look a little bit further ahead to May 2026. Jay Powell, does Trump keep him around for another term?
You know, I cannot foresee that happening. Jay Powell, Michael Barr, several have been very forceful in pushing forward with the central clearing of treasuries, with Basel III Endgame. This was going to have been Powell's legacy, trying to regulate the shadow banks and bring them into the conventional regulatory framework. I really don't see Jay Powell as having the desire to stay around after May of 2026, even if he was to be renominated.
All right, Danielle, got to leave it there. Have a wonderful new year. We'll catch up with you on 2025. Danielle DiMartino booth over at QI as we continue to round out the show here on this New Year's Eve. Folks already starting to gather in Times Square here in New York City for that wonderful ball drop. And of course, that puts security back in focus. The conversation up ahead with former NYPD Commissioner Ray Kelly ahead of tonight's festivities. You're watching Bloomberg Surveillance.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services even in time of crisis, as well as to see the long term and deliver good results, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
Politics to the world of business. Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The S&P poised now to close out with its 5th straight quarterly gain, capping a 24% rally on a year-to-date basis here in 2024. Futures right now pointing to a slightly higher open of about 0.3% when the market does open at 9:30 a.m. in New York. The euro-dollar unchanged on the day, relatively unchanged on the day, and there's your 10-year yield. We'll call that unched on the day at 4.5%, higher than where we started the year, but below the peak of around 4.7, 4.8, and a lot of questions about the directionality going forward. Unchanged right now on crude oil, despite an earlier bid in the early session, up about 1%. Looks like it's going to close out the year also slightly lower fractionally on a year-to-date basis. That's the lay of the land right now in financial markets, of course, with trading expected to be light as a lot of people still on vacation from the Christmas holiday, the Hanukkah holiday, and of course the New Year's holidays. New Year's Eve already taking place around the world and set to take place in about 15 hours or so right here in New York City. Around 1 million people expected to flock to Times Square in Midtown Manhattan to ring in 2025. And you can bet there will be a lot of security, ample security resources being deployed throughout the city, despite, at least what we know for right now, no credible threats. The mayor and the security teams that he has here saying everything is safe, go out there, have fun, and the NYPD will be on alert. Let's get some insights out of somebody who knows exactly how the NYPD operates. Former Commissioner Ray Kelly joining us right now. He was commissioner during the Dinkins administration. He was also, of course, commissioner during the administration of Michael R. Bloomberg, of course, who is the majority owner of the company that owns the network you're watching right now. Commissioner Kelly, great to have you here. Let's just talk about the basic sort of security measures that we typically see for these big events, like the Times Square ball drop, where you have to corral hundreds of thousands, if not millions of people into one tight area and make sure that all those people get in safely and, more importantly, get home safely as well.
Right. It's a real challenge, no question about it, but I think the NYPD has done it pretty well for many years. You know, there's a core area that in order to get there, you've got to enter either on 6th Avenue or 8th Avenue. And that's where anyone going into that area would be subject to a search. At least their bags will be searched. They'll be subject to magnetometer searches, that sort of thing. And the standard things that are done in these situations, for instance, the manholes are sealed, the mailboxes are taken away, those sorts of things, which are pretty standard. And we say now that there's a counterterrorism overlay. Particularly, we started doing that, or the department started doing that, since the horrendous events of 9/11. That means more police, more specialized units, more sniper teams, that sort of thing. And as the commissioner said yesterday, there's no credible threats that we're aware of. She also mentioned that drones will be increased. The department has been using drones for the last few years, and I think that's a good thing. So lots of cops, no question about it. It's manpower intensive, and I think another thing to be aware of is that in the other 4 boroughs in New York City, there are major New Year's Eve events that require a significant police presence as well.
Well, that's
you've done this before.
Yeah,
let's put it that way.
Well, that's a good point, and obviously for our viewers outside of New York, 5 boroughs here, obviously the main celebration in Manhattan, but as the commissioner points out, a lot of other festivities going on all around the city, and I know that keeps the cops busy on a day like tonight. Do you sort of, in the past, do you get all the cops on the clock for a night like this, or the majority of them, if you will, or are you able to kind of do with your normal allocations that you would on a normal day?
Well, that's the challenge. We have to police the rest of the city, and 8.4 million people, whatever number you want to use. So most of the police that you'll see tonight are on overtime. It's not on their regular scheduled tour of duty. It's an expensive proposition, but that's what the department has to do. There are some manpower concerns as far as people leaving the department. So in order to police an event like tonight, a huge event, you're going to have to pay a lot of overtime. But the rest of the city will be adequately policed.
I am curious, too, just about some of the recent events. I mean, obviously, there are a lot of security measures that are, to a certain extent, static. I mean, you can apply them this year, and you can apply them 10 years from now. We've had a couple of incidents in New York, obviously, with the killing of the United Healthcare executive. You've got a lot of, political differentiation, if you will, for lack of a better word, and concerns about the security measures needed to protect those folks. How does the NYPD adapt kind of these sort of newer and more unique challenges that maybe puts people in danger?
Yeah, there are no guarantees, but there are things that you can do. Obviously, you monitor social media closely. Usually, if there is some sort of political demonstration, it's going to surface on the internet. We watch certain people. That's people who have a record maybe of disruption and maybe have been hinting about coming to the event. We may surveil them, not necessarily in person, but determine whether or not they've gotten airline tickets, that sort of thing. So, as I say, no guarantees, but the department is doing everything that reasonably can be done to protect the city tonight.
I am curious, though, if I can get your thoughts about the health of the department, of the NYPD. I mean, since Mayor Adams took over 3 years ago, we've gone through, well, 3 official commissioners and 1 acting, so basically 4 people holding that job. The current person who holds that, Jessica Tisch, I believe you probably have some familiarity with her, given her experience in counterterrorism back in the late aughts here. Give us a sense here of what you know about her and her potential stewardship of the NYPD over the next year and maybe beyond, depending on how long she stays.
Well, I know quite a bit about her. I hired her, brought her into the police department, and she was there for 12 years. She has 3 degrees from Harvard, a law degree, a business degree, and an undergraduate degree. She did an excellent job for me. She's run 2 major New York City agencies, DO IT, which is the Department for Technical Matters, and the Sanitation Department, and the reports have all been very, very positive. She is a decision maker. She's very smart, and I think she will do and is doing an excellent job. So I think the police department is in good hand.
Absolutely here, and it doesn't matter at all, this idea that she herself wasn't actually a cop herself. Does that matter to the rank and file?
I don't think so. I think you get over that pretty quickly. We've had commissioners who've never been police officers. As a matter of fact, the majority of police officers, police commissioners through the history of the department have not been police officers. The concept was always sort of a commission to watch the department and manage the department, and then it was reduced to 1 after Teddy Roosevelt was on the commission. So I think she is the right choice at the right time to get the job done.
All right, Commissioner Kelly, appreciate you taking time for us today. And of course, all eyes right now focus on Times Square and all those NYPD officials hoping to keep everyone safe here for yet another New Year's Eve. Former NYPD Commissioner Ray Kelly there. He served briefly under David Dinkins back in the 90s and then did a relatively long stint under Mayor Michael Bloomberg back in the 2000s. As folks get ready to celebrate this holiday, some folks already celebrating around the world. We should point out that a lot of global markets are actually closed for New Year's Day. Several markets over there in Asia, including Korea, Japan, are shut down. You had several over there in Europe also were closed. A few that closed early, like in Paris and London. Markets will be trading as normal here in the United States. The cash session set to open in just about 35 minutes time. We do want to take the time, though, to thank everyone who has joined us here on Bloomberg Surveillance and really all of our Bloomberg properties all across 2025. The explanations, the hosts, the guests, everything that we do here to bring you unfiltered and, more importantly, unbiased news about what really moves markets, what really moves our economy, and what really changes the world. We appreciate you putting your trust and your faith in the coverage that we bring to you every day. There's a whole team of people behind us, not just the folks that you see on television, operating the cameras, operating the teleprompters, booking the guests, and helping to plan out all of these shows. They are truly responsible for all of the great stuff that you see here on Bloomberg Television every single day of the year. And we appreciate you that you tuned in to us every single day of this year in 2024. And we hope that you come back and spend it with us in 2025. From all of us here at Bloomberg, have a happy and healthy New Year.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, weeknights at 8 p.m. Eastern Time, right here on Bloomberg. Context changes everything.
what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
A continent of vast opportunity and endless potential, but not without its challenges. Bloomberg highlights the players and unpacks the issues shaping the African story. We'll bring you interviews with key newsmakers and expert analysis, getting to the heart of business, politics, and economics in the region. I'm Jennifer Zabasaja, and this is Africa Amplified.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Romaine Bostick in Detroit, and this is Bloomberg.
Good Tuesday morning. Happy New Year's Eve. I'm Matt Miller here in the Bloomberg Interactive Broker Studio with my partner in crime, Sonali Basak, as well as Paul Sweeney. We're invading his show once again. Bloomberg Intelligence and Bloomberg Open Interest are combining in a simulcast. So we're going out on radio, on television, and on YouTube
You're gonna
as
miss
well.
us tomorrow,
on YouTube
Paul.
as well. I know.
I'm just going to call it.
Tomorrow we won't be here.
No.
Thank the gods. But
How about January 9th? When the market's going to
January, I was wondering that this morning as well. I think it depends on how much respect we have for President Carter. You
Which
know?
is a lot, so we will be here and we will covering.
If we really want to honor him,
Right.
you know, we won't come to work on that day because the market is closed.
Yes.
What would we do?
Well, we come to work, rain or shine, hell or
But
high
not
water.
when the NYSE is closed for trading. Typically, there is no day when the New York Stock Exchange is closed that we're here. I mean, maybe you're here, Sonali, but me and Paul, definitely not. We have a lot to talk about today. Sonali, tell us what you like to do on New Year's Eve.
I am really cheesy. I can't believe you're putting me on the spot here. I write all my thank you notes in the morning to everyone that I worked with all year. I plan for next year. I've already torn apart the building and let everybody know what to expect through January 31st. What do you do?
It is pretty cheesy, but that's why you're so good at your job, right? I don't do anything special. I was listening to a new, to me, band this morning called Frog Wings. By the way, Fish is playing the New Year's Eve show tonight at Madison Square Garden.
Big.
My family goes every night.
Do they go every night? I mean,
Every
it
night.
is, I think, the best run that they do all year, although it's the only one I go to. And I'm trying to get Howie Schneeweiss on the line later on today.
And who is Howie?
And to give us a preview of the show. Howie has been to like 300 fish shows. He's a producer. He's an advisor to Cash or Trade, if you know that app you use.
All I know is I'm going to be listening to Frog Legs now in January.
Frog Wings.
Frog Wings.
Frog Wings. Highly recommend. It's an old jam band.
I bet Paul's partying tonight.
Oh, raging hard.
What are you doing tonight?
7:30 dinner reservation with buddies, and then hopefully in bed by 9:30.
Before the ball drops.
Yes. Oh yeah, please. Come
Far,
I
that's
don't
for
buy
kids.
it.
Yeah.
Let's get over to Isabel Lee. She's going to party hard tonight. And she's going to take a look at the year that was and the year that will be for us in stocks. Isabel?
I'm looking at NVIDIA. So it completed an acquisition of Run AI. That's an Israeli startup founded in 2018. It basically helps manage AI infrastructure. So news of this first broke in April, but now it's completed. So the software currently works only on NVIDIA-based systems. It will be open sourced, which means basically NVIDIA's rivals like AMD and Intel can also adapt to their hardware. NVIDIA, of course, declined to comment on the deal's value, but an Israeli newspaper reported that its transaction deal is valued at $700 million. So it's really just another deal for NVIDIA, who has proven so far this year with its spectacular 170% run that it's unrivaled, so to speak.
You're also looking at MicroStrategy.
The buying spree continues, Sonali. It's the 8th straight week that the company bought Bitcoin, $209 million worth. This is the fewest that it bought in this entire stretch. In November 25, it bought as much as 55,000. And in total, it holds more than $45 billion worth of Bitcoin. Basically, it's a Bitcoin company. That's what many people say. And last laugh is on everyone, because even if Michael Saylor, who's the co-founder, has long been mocked, kind of, now NVIDIA has risen to the top. I mean, just last week, it officially entered NASDAQ 100, and its market value is touching $100 billion. So, of course, there's a risk if people sell. It could unleash a wave of selling. But still, it's really been a spectacular year for MicroStrategy. It's up almost 400%.
But it's interesting because you do see Bitcoin finally back on the rebound, back to 95,000. This is what I wonder. If you stop seeing MicroStrategy buying every week, because there's been 8 straight weeks of buying, what does that then do to Bitcoin? Is it a signal that, all right, maybe they're holding off for a while? Would it spook the market if they don't have that 9th, 10th, 11th, 12th,
Well,
13th
think about
week of buying?
why is gold up the most that it's been since 2014, 2015? I think 2015 was the last
Central
time.
banks have been buying.
Because central banks are buying. So they're the Michael Saylors of the world. They're stuck in the past. You know, they're defending the old physical safe haven by stocking up in gold. But what did they stop buying?
You know, my name means golden. I'm going to at least take it till I die.
What means gold?
My name.
Shonali?
Yeah.
Means gold.
In
That's
Bengali.
beautiful. Really?
That's very nice. I did not know that.
I did not know
So
that.
gold
How did I not know
live
that?
on, Matthew Miller.
I just think, you know, there are some interesting parallels, right? Because Michael Saylor continues to buy at a pace that central banks continue to buy. They're just buying different sort of generations of safe haven.
It's fascinating.
Yeah.
Isabel, what else? Verizon? You looking at Verizon?
Easy.
VZ, definitely. It was hit with a proposed class action by retirees who say that the company, quote, improperly shifted pension benefit responsibilities to risky insurance. So companies like Prudential and RGA. We have former employees alleging that the company breached its fiduciary duties and jeopardized their savings. So the lawsuit is the latest to take aim at what's known as pension de-risking transactions. This basically means a sponsor of a defined benefit pension plan lessens the risk it faces in connection with another sponsoring plan. So this issue has boomed over the past year, and the complaint also takes aim at State Street. It also said that, you know, it's a planned fiduciary, but it acted in its own financial interests rather than those of the retirees. So it's really interesting to see the outcome of this. And I mean, to accuse a company of not taking your fiduciary duties responsibly is kind of.
I think this is fascinating. You know, this is one of the hottest trades on Wall Street. It sounds esoteric, but
What's the hottest trade?
These pension risk transfers.
Really?
Yeah, because they bulk up the insurance assets for then a lot of private equity firms to manage. So if these firms keep getting, if they get sued more and more, it becomes a riskier business in a lot of ways.
Oh, interesting.
Paul, you should watch Bloomberg Open Interest weekdays from 9 to 11 a.m.
Should I?
At about 9:50, Shonali's Wall Street Beat segment airs, and we often talk about risk transfers.
I didn't know that.
Yeah.
Maybe because I'm on the radio at that time. And simulcasting on
Demystify it,
YouTube.
because Matthew's mother wants to know in layman's terms. I really think it's just Matt that wants to know.
No, my mom and dad watched the whole program yesterday.
Wow.
So.
And Verizon is up just 5% this year. Nerdy fact, this is the only time in a year, according to Joe Weisenthal in a tweet, that the YTD function is the same as the 1 year. It's kind of nerdy, but.
Year to date is same as the 1 year.
Yes,
total
today.
returns on the Bloomberg terminal. Only Joe Weisenthal would
I missed the GPCT function on the terminal.
I don't know that. What's that?
You used to be able to graph percentages. So, for example, what was I was looking at gold today. So it peaked at the end of October. It was actually up 35% year to date at the end of October. But with the GP function, you can only see the absolute, the price.
Yes.
And with GPCT, it would automatically show you the percentage depending on the time you put in. I got to find out with the programmers why they've dropped that.
I'll talk to Tom from the fourth floor. He might know.
Yes.
Isabel Lee, thank you so much for joining us. We appreciate that. Isabel Lee, give us a breakdown of what's happening, what's moving here in these markets. 23 minutes until the cash market opens. Max Wasserman joins us. He's a co-founder, senior portfolio manager at Miramar Capital. Max, thanks for joining us here. I can't imagine what you're telling your clients here for 2025. You've just delivered a couple of years where the equity markets are up over 20%. Do you have to kind of talk some people off the ledge and say, boy, that's kind of unusual, folks? Don't expect that kind of performance in 2025. What is your message?
Well, Happy New Year, first of all. But yes, what we're telling clients is we think there's a lot of risk built into this market, given that high performance you've had in like these magnificent 7 stocks. So we're actually telling our clients to de-risk a little bit. So we think taking some investments and some profits from these magnificent 7s is a good idea, and position the portfolio a little bit for more volatility going into the first half of the year, because you have a change in interest rates potentially happening, and you also have fiscal policy with the new presidency. So we think, given the valuations, we're looking for other areas of the market where we have more value and more dividend growth because we're dividend investors.
Are interest rates a worry, Max? Shanali's been pestering people for the last few months about the 10-year level, and we still see it above 450, right? That must be restrictive to some businesses, to some consumers. Is it a problem for stocks?
I don't believe it is. If you look at the beginning of the year, when the S&P was trading roughly at 22 times earnings, and the 10-year Treasury was under 4%. Now you have it trading at 27 times earnings, and we're about 450. So you've had growth in the top tech stocks, which has carried and offset, I think, any changes in interest rates. But the trend is lower on the short term. I mean, that's what the Fed has been telling us. But that being said, if you see a shift, if you see inflation remain sticky, and if you see growth remain strong, which it is, imagine for a moment that the Fed decides they're not going to cut anymore, or just maybe one time. Or imagine if they reversed it a little bit because inflation is there and the spending, and you could see the 10-year back up to 5%, 5.25% potentially, which nobody is anticipating. If that were the case, we'd be pretty concerned about these high valuations.
So when you see the bond market behave in such a manner where yields are higher than not only most of the market expected, but kind of really pricing in a range of risks here, not just inflation, but also that term premium that could be associated with the U.S. fiscal load as well. You fast forward a couple of weeks, you had the Treasury Department write a letter to Congress saying we may hit the new debt limit again just around the time of inauguration. That's a lot of political uncertainty. What does that mean in terms of the term premiums and the additional payments that investors are going to require in the bond market heading into next year, given all that uncertainty?
Well, I think what it means is people are not pricing it in the equity markets. The equity markets is pricing in a Fed put, and they're pricing in, I think, an imagination, if you will, of no higher spending. They're not taking into account what if you hit tariffs. So I think the bond market's putting a signal up there, like a roadblock, if you will, and saying, listen, be cautious, because we do have a lot of things coming. I mean, if you think what the Treasury did during COVID, they financed the majority of the debt short term. Maybe in hindsight, they should have went a little bit longer and they wouldn't have had this issue. But you have a lot of debt rolling over. And if the Fed is faced with embedded inflation and growth around 3%, which we're forecasting, it's going to be hard to cut. So I think the bond market's telling us something, and I don't think you can ignore it. But right now, the momentum has been, for the last 2 years, concentrated in a handful of stocks. And we all know, if you've been in the market a while, and I have been, when market shifts, it can get ugly. You can't say when it's going to happen, but when it does, does, it can get ugly. So we're remaining cautious. And we're telling our bond investors to say shorter term, like 2-3-year treasuries, and wait a little bit before you go longer term, and to de-risk a little bit in the equity portfolios.
De-risking in the equity portfolios, Max, to me, a lot of times that sounds like healthcare. Is healthcare a sector you're looking at?
Sure. I mean, it's a good question. Again, we're looking for dividend growth in the portfolio as well. So while we have a lot of the large cap Magnificent Seven, we have several of them. But yes, healthcare looks interesting, trading at 13, 14 times earnings, roughly giving you 3 to 4% dividend yield and dividend growth. It also means industrial stocks have been hit very hard. Looks interesting. Some of the financials look good for us. Defense stocks. I mean, there's a whole plethora of companies. If you look in the equal weighted part of the market, that trade at 15, 16 times earnings or lower. It's just when you take the Magnificent Seven in, they're really skewing it. So yes, it's healthcare, but just not healthcare. It's also other areas, industrials, financials, even energy, which is nobody really liked a lot this year. But if you look at the pipelines, which we do have investments in, they've been tremendous. They've been at 40%, paying you 4 to 5% dividends this year.
Max, we thank you so very much for joining us today. Of course, that risk appetite, those were seen at the year end, a few trading days of losses here. We're snapping back into the green to end the year strong. Of course, it has been a magnificent year for the Magnificent Seven and many other stocks as well. Up next, guys, we're going to talk about something that I'm really interested in, actually. There has been a hack at the U.S. Treasury Department. Chinese hackers have gotten access to U.S. Treasury files. They learned about it in early December. We learned about it as a public just yesterday. We're going to talk more about that.
Yeah, a major cybersecurity incident is what Treasury calls it, and it comes just days after Washington said that Chinese-linked hackers had gotten into phone records as well, hacking the phones of even people such as Donald Trump, Kamala Harris, J.D. Vance. So we'll talk about the Chinese hacks. This is Bloomberg.
The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
If you look at Reels, Instagram and Facebook Reels, both immensely popular, both growing a lot, those are really working not because the short form video format is special and new. It's actually been around for a long time. You remember Vine and the early days of short form video. It's because of GPUs. It's because of large models. It's because of advancements in recommendation systems. ByteDance is one of the really great companies at this. We also have made an immense investment in harnessing the power of modern models, large data sets, and modern hardware, NVIDIA's hardware and our own hardware, to build recommendations that make the products better and more engaging. Our advertising system is built on modern AI recommendation technology. So I always think it's interesting when people remark that like AI just arrived. It's actually powering already today a huge amount of the engagement and quality of our products.
I'm Professor Hannah Fry, mathematician and writer. In this series, I will meet the companies, people, and pioneers transforming the world.
It's like the Jetsons meets the Flintstones.
Whatever future you dream of, if it affects us, I will explore it. The future is coming.
As we get set up for the final trading day of the year, as Paul gets hydrated here in the Bloomberg Interactive Brokers studio, we are looking at gains. And that is somewhat remarkable because we've had such a bad December thus far. Shonali, we're down 2% in a month when typically we're up about 1%, at least over the last 25 years.
It's incredible because you're having actually the worst month for the S&P 500 since April, where we saw a 4% decline There have only been 3 losing months this year, which helped drag the index much higher. But you have to wonder, we are still under that 6,000 level. And so the people who bought at the end of the November are actually still in the red.
And April is a horrible month. Ever since 2017, it's just been the worst month.
For me, it's always October because of the October crash in 1987. So I'm always like, if I can get through October, we're all good.
He's seen the worst. We're not that bad.
Down 22% in a day, dude.
It does that does raise the little hairs on the back of your neck if you're long equities, especially in a market that's been up, right, 25% year after year. Yeah, that would be tough to deal with. Chanel, let's talk about the major cybersecurity incident at Treasury.
You know, it's really interesting, Matt, because when I've spoken to investors, this is one of the biggest risks that they are afraid of because, of course, the Treasury Department is really the lifeblood of the financial system, the U.S. Treasury market, and it has so much data on every single note that is out there. We're going to talk about this more now. Remember, the Treasury Department notified lawmakers just yesterday that a China state-sponsored actor infiltrated workstations in what, as you've been saying, officials are now calling a major incident. We're going to bring in Jamie Tarabay, who covers cybersecurity for Bloomberg. How do you see what happened to the Treasury Department compared to what we've seen in other hacks that were facilitated by Chinese actors, state-sponsored actors?
It's almost like another day, another hack, quite frankly, at this point. We have been dealing with years of widespread, long-running hacking campaigns, whether they're cyber espionage or pre-positioning in the possible event of a conflict with Taiwan. But we have seen just literally years and years and years of attempts and intrusions and compromises of American and international critical infrastructure networks by Chinese state-sponsored hacking. So this is something that has been happening for years, and the more obvious and the more we talk about these things, the more the expectation is that we expect minimum cybersecurity standards from not just the private sector, but from government agencies, especially one as critical as U.S. Treasury.
What's the expectation as to the defenses of some of these government agencies? Is the belief that the U.S. government has decent cybersecurity defenses or not?
You know, that's a really complicated question because a lot of the time, a lot of these federal government agencies depend on contracts with third-party providers where they have devices that often they're called end of life. So they're routers or they're interconnected devices that basically connect networks together, and they haven't been updated or they are obsolete and they need to be changed. And because bureaucracy and the federal government is so large, it's always a challenge. It always costs money, and it always is a big undertaking. So we are seeing more and more and more of these end-of-life products being compromised. We know more about the fact that these are entry points in a lot of different hacking campaigns. So it's really we want to see more cybersecurity audits. We would love to see more transparency from federal government agencies about what they're doing in terms of shoring up their systems, using third-party providers, using incident response, using cybersecurity firms, as well as deploying agencies like CISA, the FBI, and other agencies that are concerned with cybersecurity, particularly as we know and has been said repeatedly by government officials for years now that there are Chinese attempts and actions to get into our systems to basically have access to intellectual property and as well as intelligence gathering purposes.
By the way, the Chinese embassy in Washington says it opposes, quote, smear attacks against China without any factual basis. They say the U.S. needs to stop using cybersecurity to smear and slander China and stop spreading all kinds of disinformation about the so-called Chinese hacking threat. How sure are we about this stuff? Because I think it's a huge allegation. It could be construed as an act of war, frankly, hacking the Department of Justice, the Department of Defense, the Treasury. So is it firmly, evidenced that Chinese state hackers are behind this stuff?
I think the phrasing of the letter that Treasury sent to Senators Sherrod Brown and Tim Scott were basically saying that they had denoted it as a major cybersecurity incident, which is what they do when they attribute it to a state-sponsored actor. And the fact that they said that after the investigations by government agencies, the attribution is crystal clear, makes it extremely definitive. They would not be putting that in a letter to Congress if they weren't sure. And it would meet the hallmarks and tradecraft of previous Chinese hacking attempts. So there are indicators of compromise, there are tactics and procedures that these hackers would be using that are identifiable to the people who track them. And there are also, companies like Microsoft that have visibility over the internet and watch certain threat actors as they move across networks, and they're able to recognize their patterns of behavior,
Jamie,
as well as the places that they're in.
Jamie, the Treasury Department was notified on December 8th by a third-party provider. They notified Congress on December 30th. So
by the way, ironically called Beyond Trust. You can say that again, right?
Yes.
Yes, that there is an irony to that. But the 3-week lag is what I want to ask about here. Why did they wait so long to notify lawmakers for such an important government body?
That's a great question. We would love to know. And right now we're not getting that information from Treasury. A lot of the times when, particularly this past year, you would have heard about Salt Typhoon and Volt Typhoon, which are extensive hacking campaigns. A lot of the telecommunication companies that have been impacted have not disclosed those hacks because they've been getting waivers on a national security basis that they would have agreed on with the intelligence community, with the government. So if they have not being able to declare or disclose those hacks, it's for myriad reasons, including national security, but also they want to be sure that they know what they have. They also want to probably be able to say that they have eradicated the problem, that they've mitigated any kind of compromise, and that they're able to sort of say, we found it, we've detected it, we're dealing with it, it's over.
Jamie, thanks so much for joining us. Jamie Terabay reporting on that incident. And it is the one that we know about. There are others, perhaps, that we don't, because Beyond Trust said that a limited number of customers, plural, were involved in this hack. And they also have contracts with the Department of Defense, with the Department of Justice, with the Department of Veterans Affairs. It could be those other agencies haven't gotten back to us and haven't alerted Congress, as far as we know, that they were affected as well. And Paul, as you point out, this really makes you rethink the TikTok issue.
That's kind of the issue I thought about when I was reading the story today was, does this put the TikTok issue, which the Supreme Court presumably will take a look at soon, does that put it in a different light for some people? And I suspect it will, because who's to say what's China state versus China private? I don't have a clear understanding of that. And
well, isn't that the same thing?
I think it is for a lot of issues. And
the other thing about this, too, is the Treasury Department around that time, December 8th, there was a lot of issuance since then. And there was a lot of, wrangling around the debt ceiling and the U.S. fiscal situation.
Yep.
What kind of interference was there? And can they show that there wasn't a significant enough interference to markets? Was there any? It's hard to understand really what the ramifications are from the hack itself.
Yeah, absolutely. I think there's still a lot to unpack here. By the way, issuance, I didn't realize, has grown threefold in the last decade in terms of treasuries. That's in the primary market story today.
And it's also crazy because so much of it is at the short end of the curve. This was one of the biggest critiques of the Treasury Department. As Scott Bessent takes over, the question is, can he term out that debt to longer dated securities at a time where the term premium is just soaring? It's an amazing dynamic.
Yeah, up 75 basis points according to Torsten Slok's note today.
Saw that.
Term premium out 75 basis points. We'll be back with more. Happy New Year's. This is Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, welcome back to Bloomberg Open Interest and Bloomberg Intelligence. We've combined forces with Paul Sweeney, radio and TV, together in the Bloomberg Interactive Broker Studio. Just ahead of the opening bell, we've got about 10 seconds to go until the final trading day of the year. And futures are higher, so it does look like we could at least have a positive start to the cash trade this morning after a rough couple of sessions, with the Magnificent Seven falling hard and dragging down the S&P index 2% over the past 2 days. That makes December a bad month, as Shanali pointed out, the worst since April. There you see the opening bell ceremonies on the New York Stock Exchange and on the NASDAQ marketplace. Brings a tear to my eye. Not really.
As a capitalist.
It's been a great year. Why would I cry, right? We've been up 24%. Exactly. With reinvested dividends, I think more like 26% year to date for 2 years in a row here. And if you take a look at the cash trades that plays out right now, we're up about 0.3%. And Shanali, for you and me, it's been one for the record books, right? Because we launched our show this year.
We did. I get to spend every morning with Matt Miller.
Oh, lucky you.
It has been a ride.
The short straw.
As long as he doesn't make me start riding Harley Davidsons, the peace will be kept.
You can ride a Vespa with me.
Oh.
That's how I roll.
You know what?
A Vespa on the Jersey Shore.
Maybe that'll change the game for me. I don't know. A Vespa
it's
instead
big.
of a hog.
Vespa is a great kind of gateway drug to motorcycling because it's got an automatic transmission. It's pretty easy to deal with, and it is, I would say, just as much fun as a big bike. I mean, be honest, awesome. Paul. How great is it for your mental health to get out there on a Vespa?
It's fantastic, and especially down at the shore, in the summertime, cruising up and down. It's excellent. And when people raise their hands and say, what do you ride? I'm like, I ride a Vespa, of course. Yeah, I know what's going on.
2025 resolutions, but of course, good moods here. We're ending on a higher note.
Yeah, well,
for the day.
We're starting to end on a high note. I remind you that things can change throughout the day. It's been we've had some volatile sessions over the past couple of months. Isabel Lee is here with us in the studio to give us a breakdown of what's going on. Just in the opening few minutes of trading, Isabel, what are you looking at?
I'm looking at Verizon. It opened in the red, and now it's up, but it's really flat. It's up just 0.9%. So the company was hit with a proposed class action by retirees who say that Verizon improperly shifted pension benefit responsibilities to, quote, risky insurance companies. So this includes Prudential and RGA. So former employees allege that the company breached its fiduciary duties and jeopardized their retirement savings. So the lawsuit is the latest to take aim at what is called pension de-risking transactions. It basically means a sponsor of a defined benefit pension plan lessens the risk it faces in connection with a sponsoring plan. So suits over the issue have boomed in the past year, and the complaint also takes aim at State Street. The filing says it's a plan fiduciary but acted in its own financial interest. So Shonali earlier said that this has been booming the past year, and they talk a lot about it in their show, and it's an interesting allegation because if proven, it's probably a big thing.
And probably will mean more lawsuits at different companies.
Well, I'm just looking at Verizon. The stock's up 5%. I mean, knowing this company as well as they do, being a customer forever, I just don't know what the growth drivers are. I mean, you got landlines in a secular decline. You got wireless competition everywhere you look. Broadband competition everywhere you look. That's a tough business. I guess you own it for the dividend. I don't know.
The lawsuit also reflects what we've been seeing in a lot of corporate America as well. This is around the benefits you get after you retire.
Yeah.
And so company after company, I know Matt is always asking why a pension still exists, but certain people definitely still need one.
Oh, I would love. I need a pension. It's not about need, right? It would be fantastic.
Is it the model that works? That is the question.
Well, Verizon, I mean, these are the legacy regional Bell operating telephone companies back in the day, which you did get a pension, and that was part of the gig. So,
but now that they've transferred it to other financial companies, they can't manage it on their own.
No,
or don't want to, rather.
No, got to get rid of that.
Isabel, what else are you looking at?
MicroStrategy is kind of flat, but it recently bought again $209 million worth of Bitcoin. Its 8th straight week of buying. Who knows if this will continue next year, but it's really interesting. And this week's buying is the fewest in this entire stretch. In November 25, it bought as much as 55,000, bringing their total to $45 billion worth of Bitcoin. Essentially, it's what people call now as a Bitcoin company, Bitcoin proxy hedge fund. And honestly, it's been working for MicroStrategy. Just last week, it was added to the NASDAQ 100, which drew some criticism, but still, it is a big milestone, and the next maybe will be the S&P 500, although that's a different discussion altogether. But really, it's been a spectacular run for MicroStrategy. Its market cap hit 100 billion, or it's flirting with 100 billion.
Bitcoin up 4.5% today, yes. 96,000 on Bitcoin. Remember, we hit a high about 2 weeks ago of 107,000.
Will we hit 100 back on Bitcoin before the end of the year? Will we hit 6,000 on the S&P again before the end of the year?
It's unlikely, right, in the next few hours. Although with Bitcoin, you never know, right? We have seen that kind of volatility in the past.
Yes.
To me, it's insane that this
big market buyer comes back at the end of the
Tom Keene has been making fun of me for at least a decade.
Yes.
Because of my interest in Bitcoin. But when he started, it was trading for less than $1,000 a pop.
Exactly, and as he refers to it as BitDog, and we try to correct him on that, but he's holding steady. He's one of those skeptics. He's got a lot of company. Jamie Dimon among the skeptics.
True, saying at one point, I think that Bitcoin was worthless. Warren Buffett also.
But why don't you just, here's the way to think about it. It's totally inoffensive to everybody. It's just a commodity. Right. Think about it as a commodity. Nothing more. It's not an asset. It's not a currency. It's a commodity that, like anything else in the world, supply and demand. If you have an opinion on supply and demand, you've got an opinion on Bitcoin. That's the way I think about it.
I want to hear opinions also on NVIDIA as well, because you're looking at a day where one of the best performing stocks in the market, I say one of the best performing because, of course, there were actually some firms that rose more, trying to get into the green today, but not quite making it.
We have news today that it completed the acquisition of Front AI. That's an Israeli startup founded in 2018. It helps basically manage AI hardware infrastructure. So news of this first broke in April. So the news today is the fact that it completed the acquisition. So the software currently works only with NVIDIA-based systems, but it will be open source, meaning rivals of NVIDIA like AMD and Intel can adapt this software to their hardware. So NVIDIA declined to comment on the value of the deal, but we have an Israeli newspaper reporting in April that the value is around $700 million. So an interesting point is Israel is NVIDIA's second most important market, and NVIDIA's last major deal in Israel was $7 billion, which is the acquisition of Mellanox. But still, NVIDIA's dominance is still unrivaled, and it really is exciting what will remain in store for the company next year. It's up almost 400% this year.
Yep. So the year-to-date NVIDIA, just extraordinary here, $3.36 trillion in market cap, up 176% year-to-date. And as Joe Weisenthal so sagely pointed out in his tweet, the year-to-date numbers on the Bloomberg terminal are actually the same as the one-year return. How about that?
You know, it's really interesting.
I mean, only Joe Weisenthal can come up with that.
Isabel, thank you so much for all of your coverage. Of course, that's Isabel Lee of Bloomberg News. You know, more on NVIDIA here, because what's interesting is in addition to the 177% increase you've seen in NVIDIA, Broadcom right behind it. It is now up about 110% this year. Coherent had an interesting run, 117% as well. That broadening of the AI trade might be the broadening a lot of investors hang on to.
Did you see also, producer Samantha Danziger sent out a story that I think the top 500 richest people in the world are worth $10 trillion. And so I pulled up Rich Go on the Bloomberg terminal. I see Jensen Huang at number 12, right? He's now worth, the CEO of NVIDIA, $120 billion. His worth has climbed $76 billion this year, which, I mean, isn't shocking, but it's just remarkable.
Did you say they're worth 10 trillion?
They're worth 10 trillion in total. I mean, look, Elon Musk is worth almost $500 billion by himself. He's worth 442.
10 trillion is more than 3 times the GDP of France.
Yeah, it's worth. They're worth a lot of money. That's we're talking about 500 people. I also saw at the top of Rich Go, the Waltons have increased their wealth amazingly. Jim Walton worth $112 billion, $40 billion more than he was at the end of last year. Rob Walton worth $110 billion, $40 billion more than he was last year. Alice Walton worth $110 billion, $40 billion more than she was worth last year. These are their individual net worths, not as a family.
And Alice Walton sports a unbelievable yacht, by the way, so go Google that. Pretty darn cool. Steve Sosnick joins us here. He is not on the list. I'm sorry, Steve, on the Rich Go list, but you're working hard at it. Appreciate it. Steve Sosnick, Interactive Brokers Chief Strategist here. Steve, what are you telling your clients these days about 2025? Because, boy, expectations, I'm guessing, is, 20% plus gains each of the last 2 years. Expectations may be getting a little out of whack here. How do you temper those?
The way I temper it, Paul, and good morning, is basically just, it's a tough tape to fight, although it's getting a little easier, quite frankly, in the last few days, but because I think we're seeing some asset allocation trades that have sort of hit the thinner markets. And, the mantra's been, don't necessarily fight the tape, but insure against it, because I do think that everybody's on one side of the boat right now. Even people who are not necessarily raging bulls will say, yeah, we're looking for 10% up next year. And, historically, that's a big hill to climb. And so I do think you have a lot of volatility events coming down the pipe. If you look at VIX for the first 6 months of the year versus the second 6 months of the year, it tells a very different picture, where it did nothing for the first 6 months. And lately it's been moving around. So there's volatility creeping back in. I think one of the things, if you're buying dips, and a lot of people have made a lot of money buying dips, VIX and volatility is one of those things you buy the dips in.
Fascinating. What about the dips in the bond market here? If you think about the stock market volatility, the bond market volatility has been more aggressive in a lot of ways. Is that signaling more pain to come when you think about how volatile broader markets can be next year?
It depends why we've seen this rise in rates, Janali. If it's because everybody's decided that the economy is going to be rip-roaring ahead, well, then that's a good reason for bonds to rally. I'm not so convinced that that's the case, because real interest rates have risen alongside of nominal rates. So I think it's just more demand for return on that money, and that does signal a bit of risk. And one of the things I like to remind people is the biggest thing that the U.S. exports is actually our debt. And when the amount that foreigners buy our debt is bigger than the amount of foreigners buy of any single thing we sell in the U.S. And so there's worries about capacity. There's also concerns. I happened to do a podcast blindly with Stephen Miran earlier this year, and he, his thesis was, it was him and Nouriel Roubini. That was quite a room, and they were basically, they had written a paper saying that the way the Treasury's bond issuance was going by prioritizing the short end was artificially potentially depressing rates. Well, if he's now going to be the head of the Council of Economic Advisors and he's got Scott Bessent's ear at Treasury, that actually might push out some more supply into the long end, and that's possibly why we're seeing long rates doing what they're doing, and also probably why we're seeing what I think is pension funds selling appreciated stocks and buying depreciated bonds to rebalance their portfolios.
By the way, part of the reason also that we now spend over $100 billion a month servicing our debt. You know,
makes my nose bleed.
Maybe they should have sold some more long end debt when we were at zero rates. Steve, let me ask you about the Treasury, the levels that we're looking at right now, 450 and change. Is that going to be a problem for a 2025 rally? I mean, the fact that we've gone up so far so fast, we've priced in all the good stuff we expect from the Trump administration, and we're running up against, there's a pivot in the Fed's easing, path, and now we're looking at 450 on the 10-year.
Well, right, Matt, this was supposed to be the line in the sand, and we kind of blew right through it to 465-ish or so without much concern. If we were all investing like truly rational value investors all the time, we would be saying, well, yes, the higher long-term interest rates means that the present value of the cash flows that we're buying from companies is less, and therefore that depreciates the value of the market. In reality, we're all momentum traders. Whether you like it or not, everybody's basically, for the same reason, we're going to be up another X% next year. It's a lot of momentum. It's also why it's a difficult tape to fight. And so, one of the lessons I take away was 1987. The bond market basically collapsed in 1987 as stocks rallied. So it depends why. If people are moving out of stocks into stocks from bonds, it could persist for a while. If it's really just pure valuation, yes, it should weigh on stocks at some point. It always does. It's just a question of when.
Steve, we thank you so much for joining us here. That's Steve Sashnik of Interactive Brokers. And
Happy New Year.
Thank you.
Thank you so much for your support this year. As we've launched this new show, I love to get a message, an IB from you when I'm in the middle of the program.
Yeah, we appreciate it. We all, this is a good note to say also, we love getting IBs in the program. Please communicate with us. But also, as we've been sitting here, NASDAQ 100 turned red. It's down now 0.1%. The S&P 500 is trying to hold on to its gains, but they are pretty meager. Right now, they're fluctuating between flat and 0.1%. Let's see if it holds. We're below that emotional 6,000 level. Up next, we're going to talk hedge funds. Ken Griffin had said the multi-strategy boom is over, but there's still some big gains there. We'll take a look at it. This is Bloomberg.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and a beer in my hand.
Don't miss the next Open Interest.
Top names in business are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are, and that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything.
Welcome back to Bloomberg Television and Radio audiences. I'm Shanali Bassick alongside Paul Sweeney and Matt Miller, and we are having some fun on the last day of the year because we are trying to see these markets wipe right back into the green. They're up about 0.2% higher on the day, it looks like, for the S&P 500, but the NASDAQ 100, not so much. It's looking still in the red. We'll keep an eye on these markets for you. I am stunned. We haven't really talked about it, but just want to point out, if you've looked at what the 10-year has done over the past couple of days, you're looking at a 10 basis point move lower since Friday. So yes, we're still above that 450 danger zone. 4.5% looks like we're going to end the year roughly, but we were at 4.6%. A lot of investors, I know.
So I'm not, but can I refinance the mortgage? No, not yet.
No, dude, this is the point. We've gone, look, forget about 460, right? Everyone with whom we've spoken over the past couple of months has said if we get above 450, we're in trouble. And we're above 450. So it doesn't matter that we've come back down from 460, right?
No, but what I'm watching for is if we head to 4.7, if we head to 5%. We just had somebody talk about 5.2%. And yeah, in that scenario, you have to ask not only if you can refinance your mortgage, Paul, you have to ask if this is the only type of rate you're going to get the next couple of years.
Yeah, I think that's...
Because we're staying higher.
Yeah, we spoke earlier today with some mortgage folks who said, you know, kind of 6%, kind of the new 3% now. People are kind of getting used to it. And even if you get to the low 6s in 30-year fixed, they think they're going to see some activity, people, because they kind of gotten real.
You could have had it worse. You could have been borrowing in the 70s, but
yes.
No. Historically, we're still low, but
or
it
the
feels
80s,
bad.
right? When rates were like 14, 15, 16%.
Yeah.
Feels bad for somebody who is a millennial or a Gen Z. Anyways, we are going to move on. We're going to talk about hedge funds. It's been a fascinating year. We're going to bring in Bloomberg's Hema Parmar because there was a story, a huge one, guys. Earlier this year, Ken Griffin spoke to our colleague Nishant Kumar, said the multi-strategy hedge fund boom has come and gone. But Hema, we are watching some defy the odds still.
Yes, you're seeing really a lot of still hot demand for these multi-strategy funds. You're seeing multi-billion-dollar launches. You're seeing a talent war that is persisting in the space, and you're seeing decent returns. So even though, yes, the amount of money that multi-strat funds oversee now has dipped down, in large part that's because some of these hedge funds return money because they're capacity constrained, but you are still seeing really hot demand from investors to want to invest in these funds.
What I see, though, is like back in the day, 90s, the 2000s, you had a good trader from Morgan Stanley or Goldman Sachs had 2 or 3 good years, put up a book. They could go out and raise $500 million or $1 billion in their strategy, whatever it was, and then have a nice life.
Yeah.
It doesn't seem like that happens that often anymore. It seems like a lot of the new money or incremental money coming into hedge funds is going to the really big shops like the Citadels, like the .72s, like the Millennium. Is that kind of how this market is these days?
So it is harder to raise a fund, and a lot of the money is going to the established funds. But, you know, in the past year, we have seen some really sizable launches. We've seen Bobby Jane raise $5.3 billion this year.
He wanted
Diego
more, though.
Meggia. He wanted much more. He was aiming for initially 10.
Yeah.
But still 5 is a lot. It's the second biggest launch, basically, of, you know, what we've seen maybe ever. Diego Meggia raised $5 billion. Freestone Grove, $3.5 billion. You know, there was a lull for a few years where we didn't see a lot of big launches. Maybe the last year of significant sized launches was 2019-ish. And so seeing this size of capital coming into these funds, not to mention when you look at Millennium, speaking of capital going into existing funds, they opened their doors recently and they were seeking $10 billion. They had demand for $20 billion. That shows the capital that they had to turn away.
Well, interestingly enough, too, we had Diego Meggia's firm raise money also from his prior firm, Millennium. Correct me if I'm wrong, I don't believe we saw that for Freestone Grove. Freestone Grove, no. Todd Barker and his co-founder were Citadel executives. So you're seeing kind of, we call them Ken's Cubs. Mm-hmm. They're kind of spinning off of Citadel and creating these new firms, same with Millennium. But, you know, when you think about how large those rivals are, can they really compete at the end of the day?
how
the new firms versus the Millenniums and Citadels of the world. I think Ken Griffin's comment here was kind of a warning shot across the bow that once you're Citadel or Millennium, you're kind of the king of the castle here. You can't get bigger than that, and you're going to steal the show no matter what over the next couple of years.
Yes, and the question is whether when you're launching a fund, are you looking to take on the Millenniums and the Citadels? Some of these strategies, like Freestone Grove, is actually trying to be the anti-pod shop, and they're more specific in the way they're targeting the space. Jane Global does seem to be trying to compete a bit more with the Millenniums and the Citadels because of the strategy. But what's interesting is you do see a trend, when you look at these funds being capacity constrained, not being able to take on additional money because it could impact returns, we're seeing these funds do really unique things to embrace more capital and do what they can with it. So you're seeing Millennium, for example, investing in other hedge funds a lot more often. So they'll take investor capital and invest in outside firms. You're seeing some of these funds consider private investments, which is not something they've done before. And you're seeing them bulk up their talent inside their firms to push into new strategies. Point72, we typically thought of them as a long-short equity shop. They've been pushing rampantly into macro over the past few years.
Why are these all dudes? Like, is this still just a big boys club? I haven't heard you mention one female name, and you've talked about like 20 people.
Yeah, it is still largely a male club, but we have seen some recent ones. It is still largely, yes, it's definitely male dominated.
So who are the women that we should be paying attention to in this space?
Yeah, so Mala Goenka, she's
been around a while.
She's been around for a long time. She was very senior at Lone Pine. Yep. She raised a fund, launched in last year or the year before with about $1.8 billion, the biggest female-led launch we've ever seen. Divya Natimi, ex-Viking Global, she raised a fund also above $1 billion. So we are seeing more and more rising female stars in the space. We would love to see more.
It just seems important to me because, I don't want to get any backlash. I know ESG is dead and over. God rest its soul. But some people might want a different perspective. You may want a female perspective, and that could be a reason that you go with a smaller fund, a newer fund, over, Izzy Englander or Ken Griffin.
There was a time where CalPERS and a lot of different large pension funds had a bigger effort to give money to female-led hedge funds. By and large, those efforts have really wavered. And so even from the allocator's perspective, you've seen kind of a lot of shrinking of that. Plus, actually the opposite has happened. People are giving money to those bigger and bigger managers. You covered, what was it? Tried to raise $5 billion, ended up raising much, much more. Was it Millennium opened up to money again this year?
When they raised, they were seeking 10 and they had 20 billion in demand.
Exactly.
Yes.
It's more money than you could imagine going to the bigger managers.
That's exactly the trend.
Yeah,
and so what it does not give you, and this is I have a negative bias against hedge funds. I think the risk-adjusted returns are inferior. That's just my personal opinion. I've held it since 2005. When I did raise a fund in 2005, we raised $500 million, but it was not sticky money, unfortunately. I just think they're all going, a lot of the money's going to the really, really big firms. Therefore, it feels just more institutional to me. It feels less entrepreneurial. It feels like less opportunity for alpha. And what I'm paying for is, I'm not paying for beta, I'm paying for alpha.
Are you paying for diversification?
Well, now you're not getting it, I think, because these funds are so big now.
Well, it's been one of the most tricky fundraising environments that we've had in years, over the past few years. It is harder to raise a fund if you are a new launch, especially if you don't have the tenure, if you don't have the experience. On your institutionalization point, yes, the big money comes from these institutional investors, but we have also been seeing a retailization of the hedge fund space, as we've been seeing in private equity, in real estate. And you're seeing more and more of these bank platforms really trying to get their ultra-high net worth individuals into some of these vehicles, and there's pros and there's cons to both of these efforts, but it's a really interesting shift that we've been seeing gaining momentum and velocity in the past year or so.
Scott Besson filing for an ETF before he ended up getting the Treasury nomination. The retailization is fascinating. But to your point, Paul, you have to be wondering whether they're really transporting that alpha.
Yeah, it's interesting to see, but they continue, as you have your reporting points out, continue to attract tremendous capital. and through cycles as well. So,
Emma, what you got going on tonight?
New Year's Eve plans. Out having a party tonight. Going to a party tonight, so it'll be fun.
We have one
What about you
partier,
guys?
finally.
I'm going to a party.
What are you doing?
I'm going to a party tonight. I'm actually going to venture out into the realms, the far-off lands of Brooklyn.
You're doing it. All right.
I'm going to
Skeptical
Dumbo,
yesterday.
which is that's under the bridge or
Down under the Manhattan, Brooklyn.
There you go.
Overpass.
I like it. I like it. All right, Hema Parmar, it's been awesome spending 2024 with you on our program. I look forward to more reporting from you in 2025. Matt Miller here with Sonali Basak and Paul Sweeney in the Interactive Brokers Studio. Happy New Year. We come back, we're going to talk to Veronica Clark from Citigroup. She's the Director of Research there and U.S. Economics. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
We're scaling up at incredible pace.
This region is growing so rapidly. The opportunity is really huge.
Only on Bloomberg. Context changes everything.
If you look at Reels, Instagram and Facebook Reels, both immensely popular, both growing a lot. Those are really working not because the short form video format is special and new. It's actually been around for a long time. You remember Vine and the early days of short form video. It's because of GPUs. It's because of large models. It's because of advancements in recommendation systems. ByteDance is one of the really great companies at this. We also have made an immense investment in harnessing the power of modern models, large data sets, and modern hardware, NVIDIA's hardware and our own hardware, to build recommendations that make the products better and more engaging. Our advertising system is built on modern AI recommendation technology. So I always think it's interesting when people remark that like AI just arrived. It's actually powering already today a huge amount of the engagement and quality of our products.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ये बुरा हो जाएगा.
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
Happy New Year's Eve. Matt Miller here in the Interactive Brokers Studio with Sonali Basak and Paul Sweeney. We've crashed his show. We're simulcasting on television, radio, and YouTube.com. Is the comment section open?
the comments,
Yeah,
the
always is.
live chat. Tom's all over the live chat.
Yeah, well, but Tom's on vacation. He's sipping a martini in Paris somewhere. Yep. And we're looking at some gains to finish the year. At least right now in the cash trade, S&P 500 up 0.3% at 59.24. So it doesn't look like, Shanali, we're going to hit 6,000 again before year end.
It's kind of crazy because that was the moment that everyone was so excited about. But, you know, analysts had upped their revisions all through the end of the year, 62,000 or more sometimes. Remember the exuberance in November?
Yep.
We did not even hit that.
6,500, 6,750. We heard a lot of higher forecasts. You know, we're still hovering around 6,000, which is a 25% gain plus year to date after a 25% gain last year.
And you think about the forecasts coming from Wall Street, they're looking for kind of high single-digit returns in the S&P 500, but the estimates, earnings estimates, are double-digit. So the implication is a lower multiple there for this marketplace. So we'll see how that plays out.
And of the estimates, Lou Wang, I think, for Bloomberg News, compiles these strategist estimates for us all the time. I always bio her ticker and then look up what she's got, the latest. None of the 19 chief strategists at the major banks that she surveys expect the market to drop next year. There are zero bears out there.
It's not just about that, right? Part of this is, okay, where can you find returns that are better than the S&P next year? If you believe that the S&P is only going to rise single digits.
Why want to do better? Oh, yeah, okay. If it's only single digits, maybe you can outperform with treasuries. I mean.
Well, to that point, too, with treasuries without the risk.
Yeah.
Right? People held out in cash this year did even better than they did most of the treasury market.
Treasuries barely eked out a gain. Paul and I love that INGO function on the Bloomberg terminal, and you can look at the global ag did better. I think it's up 3.5%, but U.S. Treasuries are up just like 0.6%. Oil down year to date again. Brent crude, the global benchmark, off I think 3% and change year to date, off 10% the year before that. So you know it's not good for everybody. But gold, the dollar, most of the assets that we follow and talk about a lot have been on an absolute tear. As a result, people have gotten far wealthier. The rich have gotten richer this year to an amazing extent. In fact, as we were talking about earlier, the world's 500 richest people reached a combined net worth of $10 trillion in 2024.
That is solid. I mean, all of that is in the stock market. And if you, again, you look at Elon Musk is just far and above the wealthiest person on the planet. And now he's encamped down at Mar-a-Lago. So we'll see how he spends his 2025. But I mean, you take a look at the absolute change in net worth for the year for Elon Musk, $213 billion increase in net worth.
His net worth doubled. Exactly. And not only that, there's a $237 billion gap between him and Jeff Bezos. That was on December 17th, was the largest ever gap that was ever recorded between the first and second ranked names on the Bloomberg Billionaires Index since its inception. So that is not only how wealthy Elon Musk has gotten, but even how wealthy he's gotten relative to all the other billionaires out there.
Yeah, he's worth basically the number one richest person in the world is worth the number two plus the number three. Let's get over to Isabel Lee. She's got details on RichGo for us. Isabel, that's the function you type in RICHGO on the Bloomberg terminal, and it gives you a wealth of information.
Yeah, so this story is either a feel-good story or not. You can do with it what you will, but it's really a spectacular year, especially for the world's richest. And Elon Musk is the one who dominated the world's wealthiest, to everyone's point. And it's really his close relationship with Donald Trump. And yes, he has encamped himself in Mar-a-Lago. I think it's $2,000 a night in that hotel, according to a news article I just wrote. It depends on whether Donald Trump will make him pay or what, but $2,000 a night is nothing to his fortune.
He has paid already, right? We were talking about this yesterday. He's paid like $250 million in backing Trump's campaign.
Yes, but his stay right now, he's still there, $2,000.
If you donate $250 million, if you donate $250 million to my campaign, you can stay at my house for free.
And then it's really his companies, Tesla, SpaceX, XAI, and you're right, he donated $250 million, and everyone's saying this is the best investment ever because the ROI is limitless. Who knows what will be? Who knows whether policy will be amended to benefit his company? It's really interesting. And of course, we have the stock market tiding the wave over all the riches. And of course, we have Donald Trump's victory. I mean, it sparked a historic rally. Ever since he won, we saw that the Bloomberg's Billionaire Index represented a gain of $500 billion in the 5 weeks following the election. So the Trump bump is big and real.
Taxes, yeah. You know, one of the few of the top 10, top 20 richest people in the world that saw a decline this year was Bernard Arnault, LVMH. He clocks in at number 5 richest person, $175 billion, but that's down almost $32 billion this year as luxury has run into some problems. And we're going to speak later this half hour. Deb Aiken, she covers the luxury business for Bloomberg Intelligence.
Actually, French billionaires in the world took their biggest hit ever. Yeah. It's not just Bernard Arnault. It was Francois Pinault. It was Francois Bettencourt Myers, who was once the richest, I believe. Yes, she was the first woman to have a fortune of $100 billion and now has lost the crown as the world's richest woman. So troubles in luxury that we'll talk about a little bit more later.
And you can connect this with the Chinese economy because Chinese shoppers have slowed their spending on this, and they're really one of the biggest buyers of luxury brands. And I saw an Instagram post saying that luxury is out for 2025 because, I mean, who among your friends still buy luxury items? I'm sure some, but really it's quiet luxury these days. So they say, who knows what will happen in 2025.
Well, I mean, you know, all the luxury brands, you talk to all the analysts that cover luxury, they say the Chinese consumer is that marginal consumer for luxury.
I think it's a really important point you made earlier. Is this a good story or a bad story? Because you did see that K-shaped recovery continue on in the United States, and low-income consumers still feel the brunt of inflation, while the rich did get much, much, much richer.
Yeah, I don't think there's anything inherently bad about rich people getting richer. The problem is that the
disparity.
The disparity has grown, continues to grow. We recognize this as a huge problem over a decade ago, and it continues to get worse and worse. And I think poor people need to realize you've got to kiss the ring. Go to Mar-a-Lago, donate $1 million, retract an editorial, make sure the Donald knows that you're on his side.
Not everyone has $2,000 a night to spend and a $1 million membership to pay.
I was being sarcastic.
As we were talking about, more than 85% of the country still earns $100,000 or less, and that segment of the economy is the one that's struggling the most.
Yep. If you don't own real assets, whether it's stocks, bonds, or real estate, the inflation bug was very difficult to deal with, and that's kind of what we're seeing. So, Isabel, thank you so much. We appreciate that. Isabel Lee, Bloomberg News, kind of giving us the latest on what we're seeing out there in the marketplace. Kind of mixed right here. The S&P up about 5 points here. Veronica Clark joins us. She's a director of research and the U.S. economist over there, that little bank on the quarter called Citibank. Veronica, what's your 2025 message to your Citi clients about this U.S. economy?
Yeah, I liked the previous discussion of the very bifurcated economy I think that we're experiencing, where lower income people are certainly struggling, higher income consumers are maybe what is supporting aggregate consumption. But I do think this is a very precarious economy, and that's I think the message for 2025. For our view, it really does come down I think to weakness that we're seeing in the labor market, and I do worry that the Fed has maybe gotten a bit complacent on that labor market weakening, and we do think that this is a Fed that's going to be cutting rates a lot more than markets currently priced in 2025.
The Fed is going to cut rates more than is currently priced in 2025. So you're not worried about policy-driven reinflation next year?
Yeah, not particularly. I think a lot of the fundamental drivers that we've seen of inflation over the last couple of years do look a lot better, even compared to a year ago. Even just this morning, we got Case-Shiller home price data. Home prices are running at a normal pre-pandemic kind of pace. That doesn't seem like a future source of inflation, and that's really where you would see signs of re-emerging inflation if rates were too low. We do see the labor market weakening. That means that wage growth has slowed. The labor market doesn't seem like a source of inflationary pressure anymore. I do think there's a lot of ways that we can see something that looks more like 2% inflation in 2025.
So one thing I wonder about a lot, too, is you saw that bifurcation in the economy, and you're kind of already hinting at potential further pains ahead. There was a great point made earlier today by Danielle DiMartino Booth that you might see some of those kind of middle to upper income consumers also start feeling some pain. Some of the pain might be seen as early as the coming days when you look at kind of student loan repayment rates, for example. Housing prices are still high. Cost of rent is still high. I mean, how do you think about that drift higher in terms of the pain that consumers will be feeling into 2025?
Yeah, I do think that's what we've seen, very gradually happening over the last year or so. A lot of aggregate, measures of consumer health really don't look, very comforting. We have the savings rate, which is below pre-pandemic levels and falling. Consumer delinquencies on credit cards, auto loans, they're above 2019 levels. Yes, student loans haven't been counted as defaulted yet, but they will start to be soon. Those do have to start being repaid. I do think the fundamental driver of whether people are going to continue spending is if you have a job or not. And of course, the unemployment rate is still at a healthy level, but it's been trending higher and hiring has been very weak. If we do get to that stage where people are starting to lose their jobs, that I think really would get people to cut back on spending.
What do you think drives that? I mean, what pushes companies to, I guess, if there's no GDP growth, they're not going to need to keep hiring. If there is lower revenue for these big corporations, they won't need more people.
Yeah, I mean, yeah, absolutely. We've had 2 to 3% GDP growth for a couple of years, and still the unemployment rate has risen by almost a percentage point from the lows. Hiring is very weak; it's at mid-2008 kind of rates. So we already see that businesses are trying to cut labor costs, and I do think that's a result of maybe trying to offset high borrowing costs. Rates are still restrictive. If people do start to cut back on spending anymore, if that's less business revenue, and you've already been looking for every way to cut labor costs by not hiring or reducing hours, that might get you to layoffs. We've also seen people are not quitting as much, probably for worry of finding a new job. That might mean that lack of voluntary separations might turn into involuntary separations. So there are definitely ways that you can get to that layoff stage.
Given that backdrop, Veronica, how much do you think the Fed could cut? How many times in 2025?
We think 125 basis points, so that's 5 25 basis point cuts. Of course, that's much more than what the market is pricing right now.
So how much then are you worried about the spillover effects? Because we've had investors tell us that, okay, a lot of the assumptions when it comes to stock market projections for next year are really predicated on sufficient growth. But between what you're saying about potential weaknesses in consumers and also what you might expect from the Trump government in terms of efficiency seeking and bond vigilantes just coming after the bond market potentially if the fiscal situation does not improve. All of this put together, does it signal that growth is potentially compromised?
Yeah, I think it does. I mean, we're expecting something like 1% average growth for next year. I do think, fundamentally, if we look back at the last couple of years, I do think rates are restrictive. We've had such substantial fiscal support post-pandemic, and that was the immediate post-pandemic policies, but also Inflation Reduction Act and infrastructure, and that is going to be fading in 2025. We'll see if we do get further cuts to government spending, but that fiscal impulse is flat to maybe negative for next year, and rates are still restrictive. This could be the time that it finally catches up with us.
Well, if they cut down 125 basis points, we're at 3% even on the lower bound, and that should be I would say pretty stimulative. Veronica, thanks so much for joining us. Veronica Clark there is the City Director of Research and U.S. economist talking to us about her expectations for 2025. Happy New Year to all of you. We're going to talk about how it could get much happier with luxury goods. This is Bloomberg.
I'm Professor Hannah Fry, mathematician and writer. In this series, I will meet the companies, people, and pioneers transforming the world.
It's like the Jetsons meets the Flintstones.
Whatever future you dream of, if it affects us, I will explore it. The future is coming.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to